Good morning, everyone. Welcome to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. Happy Jobs Friday to all who celebrate out there. Well, we certainly do. That's why we're starting off early for you here. And as we really gear up for what is set to be one of the more perhaps pivotal September jobs reports going into that November meeting for the FOMC, we're going to be watching for a few things. We're going to be watching across, of course, that headline figure. We're going to be watching for wages and where that trend continues to move, and then some of the key sectors as well here going into this report, Shauna.
Yeah, Brad, I think one of the things that I'm going to be keeping a close eye on is average hourly wages. We know that this is so important just in terms of the Fed's calculus, the Fed's fight against inflation, just what we're seeing in terms of if we do see a larger than expected jump in wages, the upward pressure that could potentially put on inflation and obviously complicate the Fed's fight in order to try to get inflation down to that 2% target that they are not veering away from in any shape or form, at least up until this point. So what we're expecting to see today is average hourly earnings here, some upward pressure up just about 0.2%, but that would actually bring the year-over-year growth down just a tick to 4.2%, putting it well above those pre-pandemic levels, and we are right around averaging about 3% annual growth here, but well below the peak levels that we saw back in 2022, March of 2022, when we saw growth of 5.9%. So we'll see what the average hourly wage number is here in this report, and then obviously try to determine what that means for the Fed and how that could potentially fit into their policy moving forward.
Yeah, such a great point. And really that calculus, one of the things that I'm focusing on here ahead of this report. As it comes out, we're going to be breaking the numbers for you here. But before then, take a look at this chart. And this chart comes from the chief economist at Apollo, Torsten Slok. And really what it looks at is how this calculus could play out for the Fed. And in summary, essentially in his note earlier this week, he was saying that the Fed controls the base rate but doesn't control credit spreads. And that's the reason why a soft landing is unlikely here. Now, what does this mean? Bring this back to employment for me. Well, bottom line here, he says, even if we did get weak data and after a few soft prints in non-farm payrolls and starts turning dovish, the Fed does perhaps, the cost of capital will move higher, and in short, the Fed controls that base rate, as I mentioned, but doesn't control credit spreads. So really, the conversation that we've been having, even with some of the economists, the portfolio managers leading into this report is, what does higher for longer mean in a soft landing type of want or desire that many of us have had or discussed, and how much of that recession risk is still on the table here, even if we start to get some of those soft prints and the Fed reverses course very quickly, even though some of the earliest estimates for any type of cut to be initiated by the Fed, which would be a major pivot versus the pause that we had talked about for much of the year here, that is not expected to come until first quarter, the earliest first quarter 2024 here.
Yeah, and that is also on the early side. We're hearing more and more projections just in terms of the fact that the Fed likely will not move until the second half of 2024. I took a look here at the Fed Fund futures just in terms of what traders are guessing or expecting here in terms of the Fed's next move ahead of this print. You're looking at 21% chance of the Fed hiking by 25 basis points at its meeting, the next meeting in November. And taking a look at those December numbers, about a 32% chance of a 25 basis point hike here, at least 32% pricing that in or expecting that, 4% saying that we could actually see a 50 basis point move here by the Fed. Obviously something that the street doesn't want to hear, right. The street doesn't want to see. Clearly, that would put a lot of downward pressure on this report. But really, the jobs data leading up to this print has certainly been mixed. When you take into account the jobless claims number showing that, yes, it still remains elevated, but we have seen it cool just a bit. That ADP number, certainly a massive drop that we've seen on a month-over-month basis and compared to what we've seen since the start of the pandemic. But then you compare it to what we're seeing in some of the private companies coming out, Challenger, Gray, and Christmas, saying that they're actually seeing an uptick just in terms of the hiring plans, what they're expecting to see in the labor market heading in to the holiday season. So the street's trying to figure out where the labor market stands right now. Investors obviously trying to figure out where it stands. The Fed clearly having a little bit of trouble trying to figure out where the economy stands, how the labor market fits into this, and how much weakness we need to see in the labor market in order to get inflation under control.
Let's just briefly set the stage here on the equities markets as well. Futures right now, as we're taking a look at the Nasdaq, the Dow, and the S&P 500. As of this point, going into this print and into the report here, as we're just seconds away, you're seeing the S&P 500 up flat, barely to the downside. Dow futures, Nasdaq futures, both of those higher as well as of right now, fractionally as it may be, still holding on to some slight gains right now.
Yeah, certainly. And as this number comes in here, unemployment rate ticking up or staying flat, from the prior expectation, 3.8%. We had expected a drop up to 3.7%. Taking a look at that headline number, 336,000, blowing past expectations of 170,000 jobs added here. The prior reading that we saw, 187,000, clearly a massive jump to the upside when you take a look at the jobs added here, 336,000. We're seeing the reaction in the market right now in futures, all three major averages moving to the downside here. You have the Nasdaq off just about 1%, Dow and S&P also moving lower on the heels of this print. Unemployment rate holding steady at 3.8%. We had expected a drop of just about 0.1%, but that headline number, Brad, is really what's sticking out here. 336,000 jobs added to the economy last month.
Yeah, my goodness. All right, so looking across some of the areas where the move higher was really represented here for the overall kind of job gains occurring in leisure and hospitality, government, healthcare, professional, scientific, technical service, and social assistance. That was really the lion's share of where these gains of the 336,000 versus that 170,000 expected came in from. And a few of the other major kind of call outs here, labor force participation rate. I always do kind of a quick search for what that participation rate looks like. And we're sitting at about 62.8% here. The unemployment to population ratio, 60.4%. Both of those were unchanged over the month, so really no moderation there. But when you think about just what this means for the Fed's calculus, I mean, this number coming in as hot as it has, and we've seen a few prints where it's come in hotter than expected. I think that does signal that the Fed's job, and particularly in what we may be looking at in a period of employment stagnation, even what that could mean for the economy and how much more difficult that makes their calculus. Let's bring in Lydia Boussor, who is the EY senior economist, and Joe Brusuelis, RSM chief economist, to discuss this morning's jobs report here. Great to have you both here with us. Joe, you've been with us over some of, and it must be the Brusuelis factor, because every time we get one of these hot prints, you just happen to be on commenting with us. So just take us into your thought process, take us into your instant reaction when you see a number that's this hot, almost double what the expectation was.
Well, my first sense is that it likely overstates the true underlying pace of hiring. While hiring remains solid to absolutely strong, 336 looks a bit much to me. 3.8% on the unemployment rate appears right. So look, there is a reason why we are seeing yields reset higher. It's not just the Fed's higher for longer, but I do think it's this sense that the economy is just not going to tip over unless the Fed makes a policy mistake. We're going to run the economy hot for the next several years as we transition from that zero inflation rate environment that characterized the last 20 years to this new post-pandemic era economy.
And Lydia, when you take a look at that headline number, clearly almost double what the street was expecting here. And then also we got upward revisions for the prior 2 months, July and August payrolls, 119,000 there to the upside in terms of what we had initially seen from those prints. What do you think that signals just about where we are in the economic cycle and what that means for the Fed here on out?
Yeah, this is a pretty strong headline print. At the same time, I think it was encouraging to see wage growth fairly soft. In September, we've seen also a downtick in wage growth on a year-over-year basis. But certainly, we're seeing resilient job creation, and that's going for the Fed. That's going to be reinforcing the Fed's hawkish tilt. Now, when you put these jobs report into the broader labor market context, I agree that we are seeing that softening in labor market conditions, and we've seen quite a bit of normalization in the labor market from where we were back in early 2022. When you look at that peak in tightness, we've seen labor demand coming back down significantly. Job openings have retraced about half of their post-pandemic surge. We're looking at the quits rate also back to its pre-pandemic level. So we've seen a cool down in the labor market. And I think that, in terms of the Fed, this reinforces the hawkish field, but we're going to get another inflation report. We're going to get another set of retail sales data. And we are seeing this surge in bond yield that's doing some of the work for the Fed. So we do think that the Fed will stay on pause at the November meeting.
Joe, when I was rattling off some of where the job gains occurred, I almost felt like Jason Kelce and his 2018 Eagles mummers, entire outfit that he was wearing at the championship parade, saying it's the whole team. I mean, it's everybody. Look at this. Healthcare, government, leisure, hospitality, professional, scientific, technical services, social assistance. What does that spell out to you when you have some broad-based gains across sectors like this?
Well, it means that the real economy continues to chug along. In the third quarter of the year, we're likely to see a growth rate, between 3 and 3.5%, with upside risk near 4. Right? This is actually aligned with the growth data we've been seeing. Now, one thing I do want to accent here is that if you take a look at the 3-month run rate on average hourly earnings, it's got a 2 handle on it. That's a very good thing. So we're getting this solid job growth, even as wage pressures are beginning to abate, right? 4.2% year over year, just a little bit of deceleration. But again, in that 3-month run rate, you can actually see it. Now, given the pressures that financial markets are facing right now, you've got yields resetting higher. We're going to need a little bit more disinflation to be evident. So that's something that one can hang your hat on as we wait for housing really to turn over and provide that other level of boost in disinflation. And then obviously on the margin, we're seeing gasoline prices really begin to fall. Oil prices have come down significantly over the past 10 days. And I think we'll see that. But for right now, today, the whole talk's going to be about rising yields.
Joe, you brought up housing there, and I think that's a big question for a lot of Americans. It's a question for the Fed, a question here for investors. When do you expect to see the housing market turn?
Well, it started to turn, but you're not going to see the more meaningful deceleration until next year. Look, I understand if you're out there in that 25 to 35 age group, you want to buy your first home, things are going to be difficult. You're going to be getting loans from Fannie Mae and Freddie Mac far less down, and it's not going to be in the city center or in the hip neighborhood where you want. But look, when I bought my first home, I paid 8.58%. We can get through this. It's just going to be an adjustment, and that adjustment's going to take a better part of a year.
I mean, those prices back then, I'm not saying, that it was that long ago, perhaps, Joe, but the prices were far different. We do know.
Now, Brad, the prices, there were real price differentials, but I couldn't buy on the edge of Beverly Hills like I wanted to either. I had to live over in Hollywood, right, or closer to Hollywood, where it wasn't so nice back then, not quite gentrified. So the prices are different, but the choice matrix is largely the same.
I'm just trying to get a brownstone in Brooklyn. That's all I'm looking for here, Joe. Lydia, I want to bring you back into the conversation. Precisely, yes, thank you. Lydia, when you look across the wages data here, what jumps out to you? What is the Fed going to have to consider even more so, and how it relates to the mindset of the consumer and where they feel like they are still able to go out and shop, whether on necessities or discretionary purchases here, and what that means all in for the inflation battle that they've got?
Yeah, so we're looking still at a fairly resilient labor market, and I think that we've already seen a lot of moderation when it comes to wage growth. But we're going to need to see more slack in the labor market to see that continued moderation in wage growth, which is going to help with bringing inflation back towards target. Now, I think when you look at where the economy is today, yes, the economy is still carrying positive momentum. We also are putting GDP growth in the third quarter at around 4%. But we do see a lot of headwinds for the economy as we head into 2024. And so we are expecting the economy to downshift and growth to fall below trend, and the labor market to continue to soften as companies face these higher interest rates and adjust to this higher for longer interest rate paradigm. We're likely to see less investment. We're likely to see also consumers downshifting in terms of their spending. So we do expect to see less economic activity, a downshift in economic activity, and that's going to help bring inflation back towards target. And we're going to see also more loosening in the labor market, pushing down wage growth as well.
So, Joe, this comes in as a very, very hot print, but I ask you the strike question because clearly it was pretty muted in this print, given the fact that the Hollywood strikes, which were resolved, that was already factored in last month's report, and then the UAW strike was not counted in this report, given the timing and when it started. How big of an impact do you see that being on the jobs market here over the next month or two?
Okay, right now it's just barely a blip. There's only been a relatively few number of people, I think around 2,600, who got laid off and will actually show up on the initial jobless claims over the next week or two. Look, even the broader strike is still small enough that it's just not going to make an impact. Now, should that widen out and capture all the approximate 150,000 United Auto workers, well, then it would continue for a number of weeks or months. We'd be talking about something different. But right now, that's not really an issue in the labor market. These labor strikes, they're solved relatively quickly, and then we just adjust and get on with it. Look, I think the bigger issue here is that as we're looking at the data, I noticed we had upward revisions to the previous 2 months. The run rate in job creation now is much stronger, much less than the 336,000 we saw in the month. I think the big question here is now, what's the Fed going to do now? We made the case the Fed will and should continue on their pause in November, and we're setting up for a very big decision in December. Now, my sense is we'll see some of the September number, it'll be revised back down. It won't look as strong. But given where we're going, both nominal and real yields, Fed's going to have to pivot soon to focus on that real yield and then stabilize it so that they don't tip over the economy. Because even as they pause, these yields keep moving up at more financial tightening than I think the economy will be able to withstand early next year.
All right, Joe and Lydia, always great to get your perspectives here. Joe Brusuelas, RSM Chief Economist, and Lydia Busor, EY Senior Economist. Thanks so much to both of you for breaking down the jobs number for us. All right, let's do a quick recap of the numbers that we got. Again, a blowout report for the September jobs print, 336,000. That is the strongest payrolls number that we got since January. Also, the prior 2 months revised upward. Unemployment rate holding steady at 3.8%. Average hourly earnings coming in a month-over-month basis of an uptick of 0.2% year-over-year basis. 4.2% growth. That was 0.1% lower than what we saw the prior month. Again, pressure across the board on futures on the heels of this very hot labor report this morning. Well, we've got your coverage ahead for you, 9 a.m. Eastern Time. You're watching Yahoo Finance. Keep it right here.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger here in Washington, where just moments ago, the September jobs report dropped with a blowout number, 336,000 jobs created in the month of September, blowing past expectations for 170,000. The unemployment rate holding steady at 3.8% and wage growth ticking down by 0.1 of a percentage point to 4.2% from the month of August. We also saw both July and August jobs reports revised upwards by a collective 119,000 jobs. This breaks a 3-month streak of job growth below 200,000, not what the Fed wants to see. San Francisco Fed President Mary Daly telling the Economic Club of New York on Thursday that if job growth continued to cool along with inflation and if financial conditions remained tight, the Fed would not have to hike in November. However, this report not in line with that. I will have much more on the jobs report when I talk to Acting Labor Secretary Julie Su at 10 a.m. You won't want to miss that. Meanwhile, it's been a very busy week here in Washington that saw the ousting of House Speaker Kevin McCarthy in an unprecedented historical move. We also heard oral arguments from the Supreme Court on the constitutionality of the Consumer Financial Protection Bureau. I sat down with Senator Elizabeth Warren to talk about those topics and much more. Take a listen.
Remember, this is the agency that has forced the banks to return more than $17 billion directly to people they cheated. It handles more than 3,000 complaints every day. This is what tries to keep people safer on their mortgages, on their credit cards. And the folks who've resisted them the most are the big banks and the payday lenders, the ones who largely prey on our young military members, for example, who need a little money until the next payday and find out that they're often paying 300, 400%, sometimes even as much as 1,000% interest on these loans without understanding that up front. So the payday lenders brought this case. They claimed the problem is that Congress set the CFPB up so that the funding doesn't come through appropriations. Instead, it comes from other bank fees and so on through the Fed. The problem with that argument is that's the case for every single banking regulator. It's true for the CFPB, but also for the Federal Reserve Bank, for the Federal Deposit Insurance Corporation, for the OCC, for all of the bank regulators, and it's been true throughout our history, dating back to our very first banking regulator in 1863. So yesterday at least gave me heart that the justices seem to understand that if they knock down the CFPB over its funding, they got a real problem with everything else in the financial system. And then, just to make it worse, turns out Social Security is not funded through appropriations. Medicare's not funded through appropriations. So the Supreme Court, if it decided that the CFPB can't do this, they could upend not only people's lives, but also our entire economy. So I hope that makes the court more cautious and leaves the CFPB intact so it can keep doing its good work on behalf of the American people.
Yeah, to your point, Senator, I mean, what sorts of consumer protections would be exposed here? What would be obliterated? In some of the research I did, it seemed to be that if Director Chopra if the funding were to be found unconstitutional, Director Chopra, who sits on the board of the FDIC, would no longer be able to participate in a vote for the forthcoming capital requirements that have been proposed. So what is some of the fallout we could see if this funding structure was rendered unconstitutional?
So it's everywhere. And I'll give you just one example. The CFPB is the one that designs and monitors all of the rules around mortgages, home mortgages. That's important for consumers. It's also important, frankly, for the mortgage lenders to have a very clear set of rules that says if you follow these rules, you can package those mortgages together knowing that they're safe and you can sell them on to other investors. That's how the mortgage industry works after that big crash in 2008. CFPB was put in place precisely because of the cheating in the mortgage industry that had brought down our entire economy. So you're going to love this part. As much as giant banks and the payday lenders have not liked the CFPB because it cuts into their profits, the mortgage bankers actually put in a friend of the court brief to say to the Supreme Court, don't mess around with the CFPB, because if you do, you could destroy the whole home mortgage industry. So anybody trying to buy a house, anybody trying to sell a house could find out that there's no longer a set of rules that apply. That means people can get cheated. It means you can't have a financing system that works and everybody knows that it works according to the rules. You could keep that up when you look at credit cards, when you look at student loan servicing, and credit reports right now. CFPB has just done a wonderful move on credit reports to try to get medical debt that is known to have really high error rates in it and not predict whether or not you're likely to pay your bills, to get that removed from credit reports. CFPB is doing work to help make sure that those credit reports, if they have false information, that they get corrected in a timely fashion. So it pretty much, if the CFPB got turned upside down, would touch the lives of everybody in this country.
And switching gears, Senator, House Speaker Kevin McCarthy was ousted from his speakership late yesterday. What are the implications here that you see? We've got another government funding deadline coming up in mid-November. Does it make it more arduous? And what does it mean for trying to get policy passed in this Congress?
You know, I think of this as we've got to focus on where the problem is. People say Congress is dysfunctional. Congress is not dysfunctional. We're doing our job over here in the Senate. We're working through our budget bills and other things that need to be handled. The problem right now is a handful of Trump loyalists over in the House who think that chaos, that hurting American consumers, that damaging our economy, and undermining our standing all around the world somehow is going to help Donald Trump get reelected. And look at the difference now between Democrats and Republicans. Democrats had the House and the Senate and the White House in the first 2 years after Joe Biden was elected. And what did? We passed a huge infrastructure bill that's really paying off around the country. We passed the biggest climate package in the history of the world. We put in a 15% minimum corporate tax, $35 insulin. It started to cancel student loan debts, which, by the way, just this week, the president of the United States canceled student loan debt for more people. He's now at 3.6 million people who've seen some of their debt canceled. It's making government work on behalf of the people. What have the Republicans done since they've been in charge? In the year and a half that they've run the House, they nearly didn't raise the debt ceiling and put the United States government in default. And then last weekend, they nearly didn't fund the government to keep it open. And those are their two big accomplishments. Look, we got to have people in government who believe in making government work for the people, not just here to create as much chaos as possible because it might help Donald Trump.
Senator, we've recently just gone over the so-called childcare cliff, nearly $38 billion in funding for childcare that was put in place during the pandemic has expired. I know that you pushed to try to get a supplemental in for that in this last go around. With the next deadline coming up in mid-November for government funding, will you push again for a supplemental? And what is the appetite? Have you spoken with Leader Schumer about this? Given what's going on in the House, is there appetite to push this through?
So, yes, I will be pushing. And yes, this is something that Democrats very much want to do. And I think we might be able to find some Republican allies if we can get the House up and functioning again. You know, I do want to say on this, we had a broken child care market long before the pandemic. It was hard for families to find affordable, high quality childcare. It just wasn't out there. And childcare workers are paid near poverty wages. Then during the pandemic, it all fell apart. And that's why we put federal money in. So those childcare slots would be there as mamas and daddies were able to go back to work. What this funding cliff means right now is that we're at risk for about 3.2 million babies to lose their childcare slots in the next couple of months because there's just not enough money to pay their teachers for those children's slots to stay open. Think about what that means. How many mamas are not going to be able to go back to work? How many daddies are not going to be able to go back to work? How many can't go back to school or continue the classes that they're in right now? How many babies are going to be parked in unlicensed centers where they're put in front of a television set with a whole bunch of other kids in front of, in someone's living room? Look, we need to invest in our children. And that means we need to make high quality, affordable childcare. And we call it childcare. It's early childhood education. We need to make this investment for our babies. We need to make this investment for people who are working. We need to make this investment for the businesses that need those mamas and daddies to show up for work. And we need to make this investment in our childcare workers who are doing some of the most important work in our country and not getting paid even a livable wage to do it. I'm going to push for more funding for this long term. I have a bill where we're just going to say, look, we've got to make a long-term investment. No family should be paying more than 7% of its income in childcare. Those babies are an investment in our future, and that's what we need to do as a nation.
All right, Senator, unfortunately, we're out of time, so we'll have to leave the conversation there. But thank you so much for your insight and hope to continue the conversation on this important topic of childcare with you in the future.
Thank you.
Good morning, everyone. It's 9 a.m. from the Nasdaq market site in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live. Here is your morning rundown. Say what? September's jobs report comes in hot, hot, hot. 336,000 jobs were added in the month, way above expectations of 170,000. That's the biggest gain since January, with a strong showing in leisure and hospitality leading the line.
And inflation dealing a blow to denim. Levi's is cutting its annual forecast for the second time after missing sales estimates. Executives blaming a more cautious consumer, hefty promotions, and warm weather.
And cuts keep coming. Tesla slashing prices on some of its EVs. Not great news for the company's margins, which are already at 4-year lows. The SEC is also ordering CEO Elon Musk to testify about his Twitter takeover. Heavy is the head that wears the Twitter or the X crown.
Well, the cost-conscious consumers providing conflicting signs for the U.S. economy, with third-quarter earnings from Levi Strauss showing that customers are cutting back on shopping trends, but Lamb Weston proving that they aren't holding back on a side of fries. Lamb Weston, one of the top performers, I think the top performer in the S&P yesterday, both just a bit lower here ahead of the opening bell. But when it comes to Levi's move, off just about 2%, blaming warm weather, blaming the cost-cautious consumer as a reason that they're seeing some of the pressure on their sales as of late. But Brad, this certainly sets up conflicting picture here about the consumer, because on one hand, the consumer obviously has remained very resilient in the face of high inflation, in the face of the fact that there is lots of concern about a recession. They're still out there spending. The fact that pandemic savings levels really coming down from those peak levels, almost erased by some estimates out there just in terms of what that could mean for future spending. Yet the fact that they're still feeling squeezed, they're still going out spending some just a bit. And we certainly are seeing a different picture in terms of what they're spending on and why. And Levi Strauss, at least for now, one of those discretionary items that consumers are opting not to allocate money towards.
You think about some of the different attachment rates that we've been able to discuss over the years. The fry attachment rate, the guacamole attachment rate here, and then even more so if you want to get into currencies, the Big Mac index, but we won't go in that direction. All this, though, considered, it really gives us a picture of where consumers are making micro decisions that have macro impacts here. And what do we mean by that? If the purchase that is a necessity for food, even if you're going out and placing that order on, say, a value menu. A lot of value menus came about during times of economic downturn because it was seen as some type of inflationary hedge, or at least a hedge against spending elsewhere where you might have to pay up a little bit more. And instead, you could go to a McDonald's, a Burger King, or a Yum, or any of the fast food, not retailers, the fast food chains, and say, okay, this is going to give me the most bang for my buck. But at a time where many of those instances are seeing higher either labor costs, higher costs to operate, whether that be in the energy that's taken in from their business. It's a larger cost now that we have to consider for these businesses as well, because that's going to impact their margins. And I think that's where investors are also apt to pay attention in this near-term period.
And I think a lot of this, we also just bring it back to the jobs report and the print that we got out this morning. Consumers are still spending because the job report remains tight, our jobs market remains tight and remains very strong. The blowout number that we got this morning, the fact that average hourly wages still up 4.2% on a year-over-year basis, up 0.2% on a month-over-month basis. Consumers still have money. They're being a little bit more discerning just about how they are spending their excess cash, but they still do have some, and that's really propping up some of the spending that we are still seeing on experiences and on some select discretionary items.
Yeah, you mentioned the jobs report, the BLS hitting us this day with the whoop, there it is. September jobs report show wage pressures. They could continue or be starting to abate. Year-over-year wage growth dipping to 4.2%. So what does this mean for the economy and the Fed's next move? Joining us now with some insight and to help make sense of this all is George Ball, Sanders Morris Harris chairman. Great to take some time with you here this morning. I want to get your overall read on what we just saw in this particular employment situation report that came out for September here, George.
The employment report is a jaw dropper. I don't think anybody can explain it. I don't think anybody expected it. The interpretive question then is, will it cause the Fed to raise rates in November? I think most of the pundits, most of the Irish bettors were saying no, they would not raise rates. A 336 number, twice really what anybody expected, may throw that into doubt. I've got my own view, but certainly the markets are reacting short-term downward, with the good news for the economy is bad news for rates looking ahead.
What is your own view there, George?
My own read is that they will not raise rates. I think there's
Why?
a delicate balance between doing too much and throwing the economy and small businesses in particular into a very difficult recessionary mode, and thinking we've set the course, there's enough momentum, inflation is going to gradually come down to 3% and meander toward 2%. Rates are not going to go down anytime soon. If people think that, then I think they're living in a fool's world. But I believe that the Fed will be comfortable enough not to raise rates in November.
What type of, well, that's particularly interesting. Let's actually stay there for a second here, George, because if we think about not raising rates in November, then when do you think the earliest that they should be considering perhaps letting the data continue to filter through, digesting that, and really looking at how the economy has taken or digested a lot of the policy decisions that they've made? Does that then put another hike into purview perhaps in early 2024, or are you looking at no more hikes and then eventually a cut?
Strongest bet would be no more hikes through 24 and into early 25. A high probability bet would be no cuts in 24 or 25. If we get a cut, paradoxically, it's probably bad news. The economy is doing badly, and the Fed is worried that we're headed toward a recession or some steep slowing of economic growth. So I don't think we'll see a cut for a long time, and a cut might be bad news. Are we going to see a rate increase in 24? I think the Fed has patience and actually probably some emotional desire not to raise rates any further.
George, we've seen this massive surge in yields. Obviously, yields pushing even higher on the heels of this very hot labor print that we got this morning. The bond market, 5%, has some market watchers drawing some comparisons to 1987, exactly what took place then when we talk about the massive crash. Are you seeing a risk or any sort of risk of something similar potentially happening?
I don't think we're going to see catastrophe in the bond market. I think there are things working against the Treasury market, quantitative tightening being one of them, massive debt requiring more issuance, short bonds maturing, and with short rates where they are, it's really costly to refinance. Today, with a 480 on the 10-year, and for the first time, I think people are going to start to move money from money market funds, from the 1 month, from the 6 month bills toward the longer end of the market. I think we actually are reaching the inflection point where there's not going to be bond vigilantes requiring capitulating, but we are going to see people moving money into the 10-year, even into the 30-year Treasury, and we're near a top.
George, what are investors to do then? Because by your estimates, or at least what you're expecting for the Fed to do, or believe that they will do, this would signal in all clear, even though this report doesn't necessarily signal that here from the jobs perspective.
I think that the Fed has done its job. Look, you're seeing rates in the Treasury markets. Interest rates are going up much more than they have in the high-grade corporate markets. The problem is really more with the Treasury than it is with what I call the national finances on the private sector side of things. So the Fed, I think, can sit back, they can wait. This report is very surprising, but there still is a big pickup in bankruptcies and interest deferrals among particularly smaller companies. And the Fed does not want to crush small business.
All right, George Ball, Sanders Morris Harris, Chairman, thanks so much for joining us here this morning.
Enjoyed it.
All right,
Thank
September
you.
jobs report blowing past expectations of 336,000 jobs added during the month, unemployment rate staying flat. Now, this contrasts a bit with recent data out from Manpower Group that showed that post-pandemic hiring trends are moderating and that the labor market is starting to adjust to this new normal. Let's talk about what's going on right now, what we could expect going forward. We want to bring in Becky Frankwitz, a Manpower Group president. Becky, it's good to see you. So this contrasts the government data here well above expectations. Compare that to what you're seeing from your data. Is there a little bit of some inconsistency, perhaps?
Yeah, so first, what a blockbuster report. I mean, let's start there. It definitely proves the ongoing resilience of the American consumer. And Shauna, you said yourself, they're valuing eating out, time with family. We see that in the leisure and hospitality numbers. We saw that in the food service, eating out numbers. I mean, a blockbuster report. However, our data shows like the fall season is coming. We're starting to see some cooling in the real-time job postings. So remember, BLS is a look in the rearview mirror, and we can look day to day at what's happening across industries in our country. And what we're seeing is about a 5% decline month over month in job postings. So it's not winter yet, it's just a cooling season. And that's what we're seeing real time. The other thing we're seeing that's a little bit encouraging is we're seeing holiday hiring start to warm up. And so another positive, it's not our traditional holiday, Shauna, it's more click than brick. So think a little bit back to the COVID behavior where people are shopping from home, and Amazon is leading the way. As you saw their announcements, they're hiring 250,000 more people for the season, 100,000 more than last year. And so we are seeing Americans value rewards and experiences for themselves. And this holiday season will be one of more click than brick. And ops and logistics is another proof point there in terms of just a booming sector. But I'd say overall, we're seeing some moderation with some hot spots.
Becky, just looking at this non-farm payrolls headline number, 336,000, I mean, that places us, a couple tens of thousands off of where we were a year ago at this time. And so all that considered, I mean, when you look at a print like that, that kind of sucks the wind out of this hope that maybe we might get a Fed that starts to ease its own kind of policy pathway and saying that, all right, we're seeing some type of larger trend where, yeah, we're still moving downward or at least seeing less of the jobs be filled or be out there. But all this considered, I mean, what does that spell out for these sectors that you've been continuing to monitor across and see where these gains are coming in from?
Yeah, so again, I mean, what's fueling the economy is consumer confidence. We're eating out. We're eating out within our budget, and so we saw in the top hires, Domino's. You mentioned a couple of the faster food brands. We're seeing Domino's come into the top hires in the country. Again, I said Amazon is in the top position of hires. Walmart, Dollar General, and so we as Americans continue to have confidence, but we're exercising within a more moderate budget than we had seen in the past. And so that's one big shift. The other big shift to keep in mind is for the first time in 3 years, we've seen tech drop out of the top 3 sectors hiring. So number 1 is medical. Number 2 is sales. Sales is because employers are readying for the comeback of the economy, so they want to be ahead of it. And number 3 is ops and logistics, where we saw a 40% increase month over month in job postings for ops and logistics, again, supporting this click-driven holiday season that we're entering into.
Becky, given the fact that the labor market's so tight that some companies out there are having a tough time finding the workers that they need, are you seeing a shift at all in terms of requirements or what applicants need in order to get that new job?
Yes, Shauna. So very interesting. January of this year, 50% of roles that were posted required a bachelor's degree, 50%, 1 and 2. Right now, in October of this year, that's dropped to 43%. And so you might say that's not that big of a drop. With the number, we have over 9 million, almost 10 million jobs open in the country. That's a significant change as employers continue to want to fill their jobs, which is what the jobs report shows. These are new jobs created, people matched with opportunity, and employers are wanting to make sure as they go into the end of the year and a hope for an improved economy in 2024, that they go in fully staffed. And that's why we're seeing this fulfillment of jobs, even though overall demand is starting to moderate.
All right, Becky, we got to leave things there on the morning. Manpower Group President Becky Frankowitz joining us. Thanks so much. We appreciate it.
Thank you.
Well, the Securities and Exchange Commission is suing Elon Musk to force him to testify about his purchase of Twitter, now known as X. Musk bought shares of Twitter between January and April 2022, growing his stake to 9% before offering to buy it. The SEC saying Musk missed the deadline to publicly disclose his Twitter stock purchases because if investors buy more than 5% of a company's shares, they are required to disclose their stakes. In the lawsuit filed in California, the SEC said Musk has been subpoenaed to testify last month about the purchases, but he did not show up. Now, this, of course, is just part of the longstanding battle between Elon Musk and the SEC. Some of that stemming from his famous tweets taking Tesla private at $420 funding secured. And so since those days of the issues with Tesla and now to purchasing Twitter, X now as it's been rebranded, it seems that he's not going to get any type of reprieve, at least in this form, in terms of the battle that's continued to rage on with him and the SEC.
Yeah, the SEC doesn't seem to be letting up, and they don't plan to, at least from this, to be letting up anytime soon. You mentioned the fact that this is a long history here, Musk and the SEC going back years to the start of what he said when he sent that tweet about taking a Tesla private. Now, when it comes to what's happening right now, Elon Musk obviously not one to shy away or really hide. He obviously responded pretty promptly on X, saying that a comprehensive overhaul of these agencies is sorely needed. He went on to say that along with a commission to take punitive action against those individuals who have abused their regulatory power for personal and political gain. And then he ended it by saying, I can't wait for this to happen. And it's something that he has mentioned quite a few times in the past, just the issues that he does have with the regulators and who is in charge of certain regulating bodies. But the battle between Musk and the SEC, just another issue here for Elon Musk. We know he's obviously a very busy individual with his involvement in a number of companies. The fact that it seems like he is always sending out messages, I guess that's the fairest way to say it, on X these days, not one to back down. So the fact that this is just another issue for him, and the fact that the SEC will continue to pursue him, we'll see how this all plays out.
Yeah, I mean, it's also a story of where his time is spent, too.
Yeah.
I mean, if he has to continue spending more time either in front of juries or in front of some of these legal proceedings, that takes time away from X. That takes time away from Tesla, and shareholders perhaps pay attention to that. They had paid attention to that, especially when he was going through the acquisition of then Twitter, now X. And so all of that considered, the time spent is somewhere where some of the investors in his publicly traded entity, Tesla, might consider this, and we might see some price action or at least bumpiness there. But in the near-term period of time, we'll see when we see any of these legal proceedings really come to an end, which is what Elon Musk hopes for.
He does hope for that. All right, let's take a look at what is moving pre-market. About 12 minutes to go until the opening bell. A 10-year Treasury yield rocketing back to that 16-year high. Jared Blickery joins us at the big board with some of the pressure that we're seeing in the U.S., Jared.
Yes, that bond market is on fire right now. Bonds tanking, yields surging. We'll get to that in a second. Want to check out what's happening in the U.S. futures market for equities. Here's the Nasdaq. It is down the most, off 1% at the lows down there, but off of those lows, down about 0.8% right now. The Dow faring a little bit better, down about 104 points or 0.3%. But let me show you what's happening in the sector action. We're seeing discretionary, that's retail discretionary, consumer discretionary, down 1.68%. In the pre-market. It was off 0.5% yesterday. So just adding to those declines, we have communication services down 1%, utilities. That is a very interest rate sensitive sector. Nothing that I'm seeing is in the green right now, so probably a negative, ugly open. I will say on these non-farm payroll days, we do tend to get mean reversion on whatever direction the equities were going. So if stocks go down at first, they do tend to go up and at least test those breakdown lows. Sometimes they exceed it and we end the day green. So So we'll have to see what happens here. But I'm looking at the 10-year T-note yield, 4.86%. It is rocketing up another 14 basis points. That is a lot for the risk markets to digest. That's still upsetting the bond market. I would expect to see the MOVE index head higher today. That's like the fear gauge for the bond market. And here's the 30-year. This is up 14 basis points to 5.0%. We have not seen a print like this since way back in 2007. That was when the global financial crisis was not even a glint in most analysts' eyes. And let's check out some of the other futures movements here. Here's copper. I'm going to put this on an intraday chart. You can see there was a little bit of a dip there, but interestingly, we are now higher than we were when the report was released. So maybe Dr. Copper saying not too much of an impediment for global growth. Here's gold futures sold off a bit on the announcement, but they are back up to break even. So that mean reversion is looking like it's kind of happening in some of the other markets. But right now, here's, for instance, is the S&P 500 futures. We are just barely off of those lows. So I think that today is going to be a really important day. I was talking with the proprietor of the Macro Compass, Alfonso Picatiello, the other day at the New York Stock Exchange. He said if this report comes in too hot, guess what? That's going to be another global growth dampening on risk. And that's because if interest rates shoot too much higher, we're going to have another problem with that reckoning in the equities market. Too higher, too fast is a big problem. And we're seeing that kind of play out right here.
Certainly we are seeing that play out. All right, Jared, stay with us here for that opening bell. We got to take a quick break. We'll be right back.
The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance.
Welcome to Yahoo Finance live from the Nasdaq market site. We're just about 5.5 minutes until the opening bell. Let's take a look at what's moving before the open. Philip, shares are on the move. The FDA saying that it is not satisfied with the way that the company handled a sleep apnea and respiratory device recall, saying that they need to conduct additional tests before they can start selling the products again. Now, this comes after the recall of millions of devices since 2021. Senator Richard Blumenthal of Connecticut calling for the Department of Justice to investigate the company after ProPublica and the Pittsburgh Post-Gazette reported that it kept more than 3,700 complaints about the faulty devices a secret before the recall. You're looking at shares off just over 9% here in the pre-market. Certainly a massive issue. Analysts are weighing in on this here. Brad, ING saying that additional testing will result in further delays in the process. In order to address some of these issues, the company has already taken a pretty massive financial hit. When it comes to this issue, they're facing extra costs, a major write-down on the value of the business. They've also settled a U.S. class action lawsuit. So the costs are piling up and the issue not yet behind them.
Yeah, Bernstein weighing in on this one as well here, as we'd seen this really catch the attention, as you mentioned, of some analysts out there on the street. Particularly what they had said was, well, obviously it goes without saying, that this is negative news, is what Bernstein said in a note. And then also pointing out how the FDA is clearly still not happy with the way that the recall is being handled. Shares of Philips, you're seeing them over the past 5 days down by about 1.3%. And then here we'll see exactly where they open up on the day's session here, but continued overhang here with how this recall is being handled, and that could potentially prompt, there you're seeing the extended hours move. They are down by about 9%, especially as that could prompt more attention from analysts who would then be forced to issue perhaps some type of note or even perhaps change their valuation here as well. Let's also talk about shares of Tesla this morning. They are on the move in extended hours as the car manufacturer sees shares decline by about 2.4%. They are changing their prices for, it checks notes, the 6th time this year. This time, they are slashing prices for its Model 3 and Model Y this morning. Earlier this week, the company missed market estimates for its third quarter deliveries after upgrades to its factories forced production to come to a standstill. There you're taking a look at shares, as we mentioned here. But again, we talked about the price wars earlier this week, especially when we were getting some of the production, the delivery numbers pretty much around the globe from EV manufacturers and non-EV manufacturers. But what automobile company isn't talking about EV manufacturing at this point in time? But all this considered, Tesla trying to make sure that it not only retains the market share that it's been able to amass in the EV landscape, EVs still represent less than 10% of the auto purchasing. So even as you see mandates start to be put in place in certain regions around the world, China most notably one of those nations that has instituted this, and that increases year over year. Tesla is not only trying to get people into their ecosystem, but trying to maintain them there. And that's where these price cuts make even more of a difference, in just trying to get people into it so that you can eventually get into a relationship with that customer of a trade-in, trade-up, perhaps long term.
Yeah, and I think Tesla, it was evident in the delivery numbers that they reported earlier this week. They potentially needed to price cuts even further in order to boost demand. They had already cut prices by about 15 to 20% on some models, but they still fell significantly short of the earlier in the year volume expectations that we heard laid out here from Tesla. In terms of the pressure that this could put on margins, obviously a huge issue on the street. JP Morgan out with a note earlier this week ahead of these price cuts that we're just getting today, saying that the large declines in average selling price has exacerbated the impact that we're seeing on the volume shortfall on all other performance metrics. So certainly a focal point of the street when we talk about the margins under pressure. Now, many analysts have said that short-term pain for long-term gain. And as long as they continue to somehow hold the market share that they do have in the EV business, are able to hold off some of the competitors out there. You mentioned the fact that almost every auto giant is talking about EVs, and you're right. They're all trying to figure out how they can push further into the EV business, win some of that market share there from Tesla, who's by far the leader in this space. So Tesla doing all it can in order to preserve some of that market share, being forced to discount models even more. We'll see whether or not it moves the needles in terms of demand.
Yeah, and you know, just coming full circle on the pricing here. I mean, you look at the 3 and the Y here. That is a car that is essentially, for the Y, 75% of the Model Y is the Model 3. So production efficiency is there. It's just a matter of, okay, where are consumers opting into not just the base, but also adding on some of these extra packages too. And I think that that's where Tesla is looking perhaps for some of the upcharges. If we can make sure that the base cost is lower, then how can we make sure that we're correctly marketing some of the higher performance packages, some of the longer ranges as well? And that's exactly where they're, I think, going to perhaps carve out their own strategy, not just in communication, but in marketing in some of the advances that they've made.
Yeah, Tesla needs to deliver 475,000 vehicles in the fourth quarter in order to hit their end of year target. Well, we've got the opening bell on Wall Street. Let's do a quick check of the markets. Obviously, pressure across the board following that very hot jobs print that we got this morning. Jared Blicker is standing by with more on that. Jared.
Shauna, I was just taking a look at the sector action. You're going to see only one green spot in the upper left. That is energy, and we're seeing crude oil a little bit off of its lows, but still around $82, $83. We'll see if we have time for that. But utilities, that is in the bottom right, down 1.3% in the early going. That has just been shellacked recently. Here's a 7-day chart, and you can see off 7.37%, probably going to break these lows here. We'll have to see. I did say with all this downside action, a little glimmer of hope is that we do tend to reverse that, at least test the breakdown levels. So maybe a little bit of a rally here. If it sticks into the end of the day, that would be very, very supportive, because guess what? We are seeing rates scream higher. We'll get to those in a second. I have the S&P 500 on the screen right now. We are just down testing these recent lows right here. Let's take a look at the Russell 2000. The small caps have been much weaker than everything else recently, and they are just hovering by their recent lows as well. But the real action today, I'm going to skip the 10-year. I just want to go straight to the 30-year, and this is over the last 3 months. From the lower left, and I can even show this on a 6-month chart, from the lower left, 3.5% to the upper right, 5%. That is 150 basis points in a very short amount of time. Amazing that equities have held up, in my opinion, as well as they have. Taking a look at the bond market volatility, we are off of our recent highs, but still elevated here. If we take a look at the year to date, haven't eclipsed those March highs in the bond market fear gauge, and that has to do with the mini bank panics that we saw back in the day. And then here's take a look at the VIX. VIX is by its recent highs around the 20 level, but not quite there. We did punch above that the other day. So we've seen indications that equities might be willing to roll over, but we're not seeing it confirmed in price just yet. Let me just take a look at some of our heat maps, and here's the sector action. Now it looks like energy is in the red, so nothing is in the green right now. Here's a look at the Nasdaq 100, the mega caps, everything on this half of the screen, that is red, but not dark red. Not seeing a lot of problems there except for Tesla. Tesla, which we were just talking about, flashing dark red as it flirts with the down 2% level. So interesting to see how this day resolves itself. Is the report too hot, or is it a Goldilocks? Because that headline payrolls level, that was hot, but wage growth was not, as was unemployment. That actually held the same. So all in all, maybe a mixed bag for this report. The close is what counts today.
All right, close is always what counts there. Thanks so much, Jared.
Let's take a look at some of the individual movers here. Pioneer shares, we got to talk about that. A huge move on reports that ExxonMobil is moving closer to potentially buy the shale drill. It is according to various media reports. You're looking at a jump of nearly 8%. Now the takeover could be up to $60 billion and could be ready to close in the next several days. Now, this would be Exxon's largest deal since its mega merger back in the 90s, and would also make the oil and gas company the main player in the oil-rich West Texas and New Mexico area here. And Brad, we know that the Permian Basin has long been a priority here for ExxonMobil. They've talked about the region, how it is critical, very important here to potential growth plans going forward. Now, this deal from Exxon, if in fact it does go through, it makes sense given the timing, right? Exxon, many of the larger oil giants coming off a record year for profits. They have a lot of excess money. They're looking to put it to work. And many analysts out there are saying that there's not a heck of a lot of options beyond going out there and acquiring some of the smaller players within the space.
Yeah, absolutely. I mean, consolidation is one of the things that we were continuing to keep in focus, especially if there were some buying opportunities that the major behemoths, Chevron, Exxon, were going to perhaps kick the tires on, or at least kick the drills on here and figure out if they could, I'm sorry, I know that was corny, but see if they could potentially acquire more market share either through regionality or just through operations as well. It's interesting, Pioneer looks like it has a market capitalization of roughly $50 billion coming into these deal talks here. It's a larger question of, okay, where in these consolidation efforts would this deal and how quickly accretive would it be, not just to Exxon's business, but what type of synergies would they be eventually able to sell and market to the street here as the company that typically is making the announcement of an acquisition, even though these are just talks right now, you typically see them moving lower. That's exactly what's taking place with Exxon shares. This morning, XOM is down by about 2%. Also, let's get into the food and beverage industry, a little more tasty here than oil. PepsiCo shares, PepsiCo shares, you're seeing them move on the day as well as Coke after weight loss drugs like Ozempic and Wegovy are spooking investors in the snack and beverage space. Yesterday, we heard from Walmart's U.S. head of business on the impact of food sales. Not all bad news. Goldman Sachs is seeing mid-single-digit volume growth for Pepsi in 2024, and that's without any more price increases here. So shares of Coca-Cola down fractionally, shares of Pepsi down by about 1.2% right now. And Walmart really, I think, got out in front of, or at least for the reaction that we saw from the street, was trying to signal or at least couch some of the expectations for declining performance or worsened performance in some of the aisles in their store by saying, yeah, people aren't as hungry just because they're taking so many of these what's now viral weight loss, the weight loss, but also is a much larger kind of, not even a nutrition, it's just like a pill, essentially. It's flabbergasting, honestly, at the end of the day, that so many people have gone into this and looked at it without some of the side effects that could take place. And I just kind of read through some of these and I'm just like, my goodness, all right, well, sure, yeah, it's going to impact Pepsi and Coca-Cola and Walmart. But at the end of the day, like we've got to be smarter about the things that we're putting in our bodies too.
Yeah, certainly a lot of the warnings out there just in terms of the adverse side effects that are associated with these drugs, certainly very important to keep in mind when we talk about the business implications of this, what it could mean for sales for some of these consumer staple companies. Yeah. Obviously, it's something that has been warned about by some analysts going back to March. Morgan Stanley was out with a note saying that they do expect some sort of hit here to some of these consumer staple companies, considering the fact that the pool of patients is expected to grow to 24 million people taking these types of drugs, about 7% of the overall U.S. population. That's only just within the next decade. So we talk about the pressure that could put on companies. I think investors are going to be paying very close attention to these earnings calls on the heels of what we just heard from one of Walmart's executives earlier this week. We have Pepsi coming out on Tuesday, next Tuesday, Coca-Cola on October 24th. So we're seeing some of the worry in the market when it comes to some of these consumer staples. When you see the downward pressure in Coca-Cola, downward pressure in Pepsi for a second day in a row. I think everyone's trying to figure out exactly what that roadmap looks like going forward, given the fact that if Walmart is right in terms of the trends that they are seeing and the fact that people are pulling back on some of their spending, if they are taking these types of drugs, clearly that could mean a huge hit across the board for many of these companies.
Yeah, this is even more and goes deeper than even Wegovy and Ozempic. It goes back to where people are getting this thought or getting this perception that they need to look a certain way, feel a certain way. There were studies that were initiated even pre-pandemic and leading up to the pandemic talking about the dangers of Instagram and looking at so many different figures out there that would make you want to compare yourself. And I think with all of that considered, it's time for us to perhaps reinitiate even more of those studies to talk about where there is still a role that social media has to account for, meta platforms, whether it's Google, all of these different places where studies have revealed that there are issues that show body dissatisfaction, mental health issues, all stemming from an exuberance or abundance of use of some of the platforms too. So that's not me just, I'm not a parent, I'm nobody's parent out there. You can decide what your own FaceTime, what your own screen time looks like, but at the end of the day, there are some serious disorders that have been started, and it's unfortunate as well as how that's impacted society.
Yeah, extremely unfortunate, obviously. Very important to keep in mind. All right, guys, we got to leave it there for now, but we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. MGM saying that last month's cyber attack cost the company around $100 million. This as officials suspect that Scattered Spider, the hackers linked to the MGM and Caesar breaches, is also behind the attack on Clorox, according to a report from Bloomberg. Now, Clorox warning earlier this week that it expects sales to fall by more than 20% in its most recent quarter, thanks to fallout from the hack. Now, with more on this and what these series of attacks means for corporate America, we want to bring in Allie Mellon, a Forrester Principal Analyst of Security and Risk. Allie, it's good to see you. So what this case and what these cyber attacks mean just in terms of how vulnerable many large U.S. corporate giants are. What's your big takeaway from these developments this week?
Yeah, thank you so much for having me. You know, the main thing that I would highlight here is that one of the things that we often talk about in security is that any organization can be targeted by these types of attacks. And often, especially for criminal groups that are well organized and have a system in place, they're looking for the bigger fish to target. They're looking for the bigger organizations that they are able to target and then get larger sums of money out of. So it's not surprising to see that these are the types of targets that they would choose, in particular because many of the organizations that they're choosing to target rely on continuous uptime. At the end of the day, the biggest thing that a cyber attack can cause and affect a business with is business continuity issues. And that's especially true for organizations like casinos and consumer goods. So ultimately, those are going to be huge targets because they're the ones who are really going to feel the pain from these types of attacks.
What type of cybersecurity spending as a result of these attacks are we anticipating to come about from major organizations or even public entities?
Definitely an increase in the cybersecurity spend that these organizations have. And further, one of the interesting takeaways from what's happening with Clorox right now is they highlighted their efforts towards digital transformation more broadly as a part of their announcements related to the cyber attack. That is an excellent sign because ultimately, the more that you're able to transform your organization and move towards some of the latest technologies, you change to a model that's much more focused on collaboratively working with your third-party partners, that's focused on using the latest technology, removing legacy technology that you may have previously been using, and it just furthers all of your ability to implement cybersecurity best practices from the start of the new technologies that you're working with.
Allie, some of these cyber attacks, when it comes to MGM, Caesars, they demanded a ransom payout. And it was interesting because Caesars did make that payment, MGM didn't, and now they're saying they took a $100 million hit as a result of it. What should companies be doing when they're put in this type of situation?
Well, ideally, these companies are going to lead with security best practices and not be put in these situations to begin with. But unfortunately, just as I mentioned, these things happen. These types of attacks happen. It's critically important for organizations to work closely between their cybersecurity branches and their IT branches to make sure that they have backups in place and can recover quickly. It's also critically important to have incident response processes in place so that they can recover from these types of attacks quicker. And like we saw with Clorox, so that they can communicate to external stakeholders effectively and clearly and transparently and maintain some of that trust. The more that these incident response processes are practiced across the entire business, not just security, the better, because ultimately marketing, sales, product, customer success, all of these parts of the organization need to be prepared in the event of a cyber attack that disrupts business continuity, and they need to know how to respond. So the most important thing these organizations can do is make sure that they are prepared for these incidents, make sure that the broader organization is prepared, and then have backups in place that they can recover from as quickly as possible. If it comes down to paying the ransom, unfortunately, there are some organizations that have to take that route, but that is a worst case scenario that we want to avoid at all costs because we don't want to be giving the criminals more money than they already have.
Allie, just while we have you, there are two tickers that I tend to look at when it comes to any cybersecurity conversations that we have, because it's interesting to track the sector as a whole. CIBR is one of them, and that one is outperforming the S&P 500 now year to date. It's up by about 16%. You compare that to the S&P 500 sitting at about 10% returns year to date. And then HACK, H-A-C-K, another one of them out there that a lot of investors pay close attention to here. All of these things considered, cybersecurity as an investment thesis or theme here. What most notably should investors continue to pay attention to if they were to look at this as an investment theme?
The most important thing investors should know about cybersecurity is that it's complicated. It is very complicated. There's a lot of language that's used to make it seem even more complicated. What they need to be looking for is companies that have consistent positive performance and those that communicate regularly to stakeholders and in a clear way. Because the most important thing that they can do is invest in organizations that have a clear path to profitability and that are clearly in the market and understand the issues and communicating for the right reasons. Cybersecurity is a very hot space right now. There is no doubt, and it is going to continue growing and continue being even more important, especially as we see regulations coming into place, like some of the work that the SEC is doing. So it's definitely an area that needs to be watched, but also looked at with a skeptical eye because of some of the challenges within the space.
Ali Mellon, who is the Forrester Principal Analyst here, thank you so much for taking the time here today to discuss some security and risk here with us. We appreciate it.
Thank you so much for having me.
Absolutely. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance.
Welcome back, everyone. We're live from the Nasdaq market site in Times Square, turning our attention to politics now. President Biden allowing construction on the southern border wall. The administration waiving 26 federal laws to restart construction in South Texas. It's a U-turn from his campaign promise to end the project, but he's saying he doesn't have a choice. Joining us now with what's on his radar is Yahoo Finance reporter Rick Newman. Hey, Rick.
Hey, Brad. So in addition to that, the White House said yesterday they are going to change another immigration policy and start deporting thousands of Venezuelans who do not have a justifiable reason to be in the United States. They're just going to fly them back to Venezuela. So kind of a U-turn here, as you pointed out, on immigration policy for Biden. And this could break one of two ways for him. Biden gets relatively poor marks for his handling of immigration. Polls show that voters think he's not doing a good job in immigration. And look what's happening. I mean, we've got migrants showing up now, kind of overrunning New York, Chicago, cities in California, and you've even got Democratic politicians basically begging Biden to do something. So he is trying to do something, and he's trying to demonstrate that, yes, he is going to get more aggressive on immigration. Here's the Biden problem, and he has this problem in other areas. When he does certain things, people just don't notice. Voters don't notice. Biden does not have a great way of getting people's attention and telling them what he's doing in a way that they actually remember. We've seen this with different things on the economy. Voters don't really know about all the laws Biden has signed, the Inflation Reduction Act, what's in there, and so forth. So, I mean, look what's happening today. I scanned some conservative media today, and cover of the New York Post. Biden flip-flops on immigration, whereas you look in the sort of mainstream news, and it's getting modest coverage. And Biden doesn't want people to notice immigration. He's probably not going to say much about it. So he could turn this to his advantage if he really had a powerful messaging campaign that went along with it. We're getting a handle on the migration problem, but I just don't think that's Biden's style. And I think he's not likely to do that. So I have a feeling this is going to continue to be a losing issue for Biden, even if he changes his policies.
Rick, how is this being received within the Democratic Party? Because it caught a lot of people, even within his own party, by surprise.
I mean, that's another problem. So Democrats don't like what he's doing. First of all, environmentalists, those 26 laws that you mentioned, Brad, at the top that Biden has suspended, many of those are environmental protection laws to protect sensitive areas down in the Southwest. And environmentalists are saying Biden shouldn't be doing this. So he's getting criticism from environmentalists for that. Immigration advocates say he's just reverting to the cruelty of the Trump policy. So he's getting bashed on that as well. So the Democratic Party is split on this. And, I guess in a way it should be split because immigration and the migration problem are almost unsolvable given that Congress won't do anything. Congress will not pass the sorts of reforms that might help solve this problem. So every president is left to figure it out for himself or herself. And there's just not all that much a president can do without Congress passing laws. So Biden is just he's kind of fumbling this issue. And I don't think he ever saw this coming based on the things he campaigned on back in 2020.
Certainly a massive issue here for Biden potentially ahead of the election. All right, Rick, thanks.
Bye, guys.
We got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
and we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. Hey, welcome back, everyone. I'm Brad Smith alongside Shauna Smith here at the Nasdaq market site in New York City. Yes, it is Friday. Yes, we are 30 minutes into the trading day. And yes, we're going to give you a look at how things are shaping up in the markets right now. We'll do that. Stocks sinking as the September jobs report came in hot, with 336,000 jobs added, killing any hopes of a cooling labor market and adding to fears of higher for longer rates. We're also seeing Treasury yields surging in response, the 30-year trading over 5%.
And taking a look at some of the individual movers, Elf Beauty shares are moving higher this morning after getting an upgrade from Jefferies to buy from hold. You're looking at a gain of just over 2.5%. Price target also bumping up to $115 a share, about $15 higher from where it's trading right now. The firm saying that the recent valuation pullback in the cosmetics company offering a buying opportunity for investors.
All right, BEA beautiful. And we're watching Apellis Pharmaceuticals also getting an upgrade this morning. JP Morgan analysts boosted the company from neutral to overweight and raised their price target to $81 a share. This comes as the company released preliminary third quarter results, seeing its newly released drug earning $74 million in revenue for the quarter, and $160 million since its launch this March.
And AutoZone not feeling the love this morning. The stock getting downgraded by Oppenheimer down to perform from outperform, and also a new price target slashed to 2,600, still about $100 higher from where it is right now. Now, analysts saying that in a note that pandemic era tailwinds for auto parts retailers are likely to continue to fade, undermining any potential upside in sales and EPS. So we're seeing some pressure there for AutoZone this morning. Well, job numbers came in well above expectations this morning, hitting 336,000 jobs were added to the U.S. economy, while unemployment remained flat. Let's head over to Yahoo Finance's Jennifer Schomburger live in Washington, D.C. Jen.
Hey, thanks, Shauna. I want to welcome in Acting Labor Secretary Julie Su. Secretary Su, thanks so much for joining me.
So good to see you again.
Great to see you as well. A blowout jobs report, much higher than expected, breaking a 3-month trend of job growth below 200,000. What do you owe to this? Is this an anomaly, or how does this inform your outlook for the job market?
I think two things. One is that this is further sign that our economic policies are working, that we have a strong, robust economy where people want to work and they're finding work. The second is that the overall trend is definitely for, towards stability. The average job growth over these 3 months is about 266,000. It's less than it was a year ago for that same 3-month average. And that is what we want to see when we want stable, steady growth in a stable, steady economy.
Today is National Manufacturing Day. We saw 17,000 jobs created in the manufacturing sector, continuing that upward trend. And I understand the Department of Labor is announcing an advanced manufacturing registered apprenticeship series.
That's right.
Tell us about that and what that could mean for manufacturing jobs in this country.
So President Biden has talked about a manufacturing boom, right? Wanting to make sure that we make things in America, and that is part of an industrial strategy that helps to lift up the American economy and America's workers. Today is National Manufacturing Day. We are also announcing an apprenticeship program that will help to make sure that working people, including those who have not seen themselves in these jobs before, get the pathway to those jobs. Since the president came into office, 815,000 manufacturing jobs created, and we're just getting started. We're just seeing the effects of all these historic investments, and so looking to really help to power the future of manufacturing through American-made goods by American-made workers, especially in good union jobs.
Speaking of manufacturing and unions, the UAW strike now in its 3rd week. Ford, GM looking to lay off workers temporarily. It seems that both sides come closer, and then the UAW says that they need more. What are you telling both parties now?
Well, I think it always looks like the parties are really far apart until they're not. In any negotiation, that's the case. And what gets said publicly can also be quite different from what is actually happening at the bargaining table. I think the parties are working through some really complicated, difficult issues in a moment in which we are seeing unions able to demand more at the bargaining table for their workers generally, right? We're seeing also broad support for unions, more than we've seen in 50 years. And so I think that is, that's part of this process. And we're seeing that the parties remain at the table, that are talking to each other, and I think that they will get there.
How much longer do you think this could play out?
I mean, that's hard to say, but I do think that, the president made a historic visit to Michigan to join a picket line. And I think that was an important statement that we really believe that when there are record corporate profits, there need to be record contracts for working people too.
Switching gears, House Speaker Kevin McCarthy was ousted from his speakership this week, and analysts are saying that raises the prospect of a government shutdown come mid-November. What would that mean for the Labor Department in terms of all-important data releases like today's jobs report or CPI?
Yeah, I mean, a government shutdown is devastating for so many reasons. To your question, right, coming to talk about Jobs Day, it's important not just for people sitting in the living rooms understanding what's happening in the economy. Jobs Day also helps to inform a whole bunch of other decisions that get made, including what the Fed is going to do, including the fight against inflation. So if there's a shutdown, And if the Republicans in Congress cannot work cooperatively to make sure that we keep the government running, then we don't get these kinds of jobs report in a month of a shutdown. And that is really, really harmful broadly, but it's also really harmful to people who depend on government to function.
Switching gears, we've just gone over the child care cliff. Nearly $38 billion in funding for child care that was put in place during the pandemic has expired. How do you see this impacting the labor force in the coming months?
Yeah, I mean, one of the reasons why the economy, why we were able to recover from the global economic devastation that created by COVID was investments through the American Rescue Plan, including investments in childcare. We have seen, and we've talked about this here together, right, that those kinds of investments have helped women to power our economic recovery. Women were most devastated when COVID hit, but also recovered faster. And our labor force participation rate remains at record levels over the last few decades. So the drop in support for childcare, it can be very devastating for women, not just childcare workers, but for women mostly women, right, who depend on childcare in order to be in the workforce.
If Congress can't get a supplemental pass to renew this funding, what's the prospect if they were to pass something like a child care tax credit, expanding that, tax credits in general for child care? How could that impact women's ability to participate in the workforce as well as their wages?
Right. President Biden has said from the very beginning that we need a child care infrastructure that meets the demands of working families. And again, working women bear the disproportionate brunt of child care responsibility still. And so anything that Congress can do to extend and expand and really stabilize support for child care is something that I think would be really good for the economy and a really good investment in equity.
Secretary Sue, thanks so much as always for your insights. So appreciate it.
Thank you. So great talking to you always.
Shauna, I'll send it back to you.
That interview. Now we want to get to the market commentary of the day. Could Disney knock Netflix off its top spot in the streaming space? Well, according to a new note out from Bernstein, Disney is a, quote, only credible challenger to the streaming giant. Now, Netflix has maintained its leadership in this space despite legendary networks and tech giants alike putting their hats in the ring. Bernstein analyst Laurent Yoon points to Hulu as a potential catalyst here, arguing that Disney has more to gain with full control of Hulu, and a favorable resolution of the deal would likely lift an overhang on the stock, saying in a recent note that, quote, we forecast DTC growth to outpace linear decline, supporting overall growth of media and Disney becoming the undisputed #2 subscription video on demand. Now, with a price target of $103, Yoon sees more than 20% upside to Disney's stock. We're seeing a bit of a lift here today, up just about 0.1%. Lots to digest in this note here, Brad. But at scale, at least Bernstein arguing that they expect EBITDA margin to expand from roughly 18% today to the low 20s for the foreseeable future. And the price target multiple implies a decent premium to some of its legacy peers. But still, though, 7 times turns less than Netflix, the industry leader.
I'm just excited about the advertising on here. This is a key part of this note as well. AVOD economics. All right, so we're going to do a short but shallow deep dive into this one. AVOD economics works, but can it scale is one of the parts of this note here. And it caught my attention because when you think about the advertising options that are out there for not just the consumers and kind of lowering the price that they're paying based on the tier that they're opting into, but for advertisers, for marketers who are trying to run these massive campaigns on streaming platforms, knowing the amount of screen time that is paid or ultimately amassed on each of these, and largely the 2 lion share winners there, Disney and Netflix, the not straight up duopoly, but certainly the largest of the streaming opportunities that are out there here. The AVOD arm is now basically higher than basic globally and also higher than standard domestically. What does all this mean here? The ARM is already competitive with the standard tier, and that's what they're saying about Netflix, and particularly how this relates to the larger AVOD tier. Standard tier is about $8.50 a month here. Now, the engagement and cost of advertising slots, the CPMs, cost per millis is typically what that would have been for many decades and years at this point, is what cost per essential millions of views an advertiser would be paying for here. And so all that considered, look for what Disney, what Netflix say about where their advertising tiers are showing strength, what they're seeing in terms of revenue in those advertisers, those marketing dollars, millions, sometimes billions of dollars spent in these ad campaigns that are run on the platform that can amass to a significant revenue item for Disney and Netflix to be able to report back to investors here. I'm sorry, I'm just excited about advertising and marketing.
Well, certainly it looks like we're going to see a return here. Lots of talk just about what exactly that was going to look like given the downturn that we had seen in recent quarters. But a lot of this also goes back to when you're making the case here for these businesses, for these streaming giants, comes down to pricing. And we've seen Disney Plus and Hulu raise their prices initially back in October and November of 2022. And they just quickly followed up with another round of price hikes in some of their ad-free tiers in this month here. We heard from Netflix earlier this week. So certainly there is some competition among pricing, and some of these streamers really do have the pricing power, able to pass that along to their consumers. Then obviously that would improve profitability or get you to profitability.
You had to excuse me. The marketing nerd inside me just got really excited.
You got very excited about that.
I know. It's
you
like
showed the passion. It was great.
Industry. Yeah, everyone. Switching gears here, the September jobs report that came out, and construction was one of the few sectors that saw little change over the past month. Let's bring in Yahoo Finance's Danny Romero to break down the numbers here. Hey, Danny.
Brad, this was expected for the construction sector. Construction employment added 11,000 jobs in September, and Realtor.com economist tells me that this is below the 12-month average. But breaking down to those numbers, construction of buildings added 6,500 jobs. And diving into the subsections of that, we have residential building construction added 6,700 jobs. That is a big gain compared to last month. There's been some rebound in construction spending, so that gave it a little bit of that boost there. Non-residential building construction jobs, those are jobs that build our hospitals, schools. That lost some steam and momentum there, but moving over to the heavy and civil engineering construction, that gained 2,200 jobs. Those are jobs, remember, that build our highways, dams, roads, streets. That got a boost from the CHIPS Act funding. Then moving over to the specialty trade contractors, overall gained 2,600 jobs. And so the subsections in that is residential specialty trade saw the most momentum there, 5,900 jobs, while non-residential specialty trade lost 3,300 jobs. Brad?
Danny, real quick here, what does this all signal about the overall housing market? Because we know a lot of the home builders, they haven't been able to keep up with some of the demand out there, given the fact that existing home sales simply, there are not nearly enough to meet the demand out there. So what does that tell us just about housing going forward?
Chana, you bring up a really good point. Builders are in a great position right now to build some of the inventory to the scarce market, even amid higher mortgage rates. The construction sector is really strong right now. And the fact that there is government spending, that is something to really highlight both on the public and private side of things. So Shauna, this report really was from one economist. He said that this is what was expected and also wasn't much of a surprise given the fact the overall jobs report result. Shauna?
Danny, I'll take it from here. Thanks so much for that update and tracking this very important part of the employment situation here. Danny Romero, Yahoo Finance's Zone. We've got all your markets action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance on this Friday morning, and there is a new king of beers in town, and it is Modelo, and it certainly showed up in the latest financial results of Constellation Brands. Let's get right to Constellation Brands CEO Bill Newlands. Bill, always great to get some time with you. Big quarter for your beer business, really double-digit sales, strong on profits. What are some of the drivers behind that?
The first one is Modelo, as you pointed out. Modelo is now the #1 beer in the country by dollars, and it's also the share gaining leader. We were up 9% with that particular brand. Our Chelada business, which is on screen for your viewers at this point, was also very strong. We're up 40% in the Chelada business. And we've had very good success with some of our new products. Oro, which is a light beer from Modelo, and Corona non-alcoholic, were also very strong. And of course, we can't forget Pacifico. Pacifico was up 15% in the quarter and is now the #2 selling beer in Los Angeles. I mean, think about that. So to Modelo, of course, but very strong quarter for the beer business.
Oh, I've followed your story for some time, Bill, and I remember you telling me years ago, Modelo is going to be strong. You just got to believe in it. I wasn't really a big believer, but you've proven me and a lot of other folks out there wrong. But what do you say to those people that your beer, Modelo, is now #1 in this country because of all the troubles happening over there at Bud Light?
We expected that we would take over as #1 in a couple of years. We just didn't think it would happen quite as quickly as it did. Obviously, we've got a very strong situation with the Hispanic consumer, and we get tailwind because of the growth of that consumer in the U.S. But it's also very much broadening its base as well. Today, it's 55% Hispanic, 45% non-Hispanic. So we're seeing a real increase in broad-based awareness and of that brand, and we just see it having a long runway for a long time to come.
If the consumer next year, Bill, gets over their squabbles with that Bud Light brand, do you anticipate, basically what I'm trying to figure out is how resilient is your growth in Modelo, do you think?
Our growth has been going on, Brian, as you know, for about 30 years, which makes it not anything that is unique to a point in time. This has been developing for a long, long time. And it's growing now, not only in the original base, which was on the West Coast of the U.S., but in many markets across the U.S., like Florida and the Carolinas and Illinois and Texas. So we think this has a long, long runway. And we've added some things into the franchise, as I mentioned a moment ago, with things like Oro. So lots and lots of upside for the Modelo brand.
Is that Pacifico brand, and you told me about a year ago, too, to watch out for this brand, so I've been watching it very closely. Is that the next Modelo for Constellation Brands?
We think it could be. It's done very similar to what Modelo had done, which was it created a very strong franchise on the West Coast. I mentioned to you a moment ago, it's now the #2 beer in LA behind Modelo. So it's got a tremendous franchise, but you're starting to see very strong shoots of growth in other markets around the country. And it tends to be a somewhat younger consumer. So we're very enthusiastic about the future of Pacifico, and we do think that it could easily be the third big leg on the stool with Corona and Modelo.
Another tough quarter in the wine business, and you guys have really tried to turn things around. I suspect when you have your investor day in a couple weeks, investors will hear more from you on that front. At what point do you just say, maybe we don't want to be in some of these wines, and maybe we don't want to continue to reinvent a brand like Svedka Vodka?
We've spent a lot of time over the last few years reinventing that business. Just 3 years ago, 2/3 of the business was in the low end or mainstream portion of the business. Today, it's 1/3, and the higher end of the business is performing very well. The mainstream, however, is not. It's almost the tale of two cities. But we're seeing excellent growth at the top end with brands like Meiomi and Kim Crawford and High West, and The Prisoner. We're seeing a lot of opportunity there, which we think will really turn around in the back half of the year as we see many of these brands accelerate.
Of course, Bill, today is Jobs Day in America, really blowout jobs report, I think shocked a lot of people on the street. How aggressively are you hiring in your business?
We're probably fairly stable within our business. We're obviously growing our production footprint in Mexico because we're adding a third brewery. So you're seeing quite a bit of increase in that particular area. But I'll go back to your comment about the jobs report. That speaks very well for us, for the beer business. There's good employment is very good for the beer business. And obviously, as the share leader and the growth leader in the category, we're there to absorb a significant portion of that added spending power that the consumer has.
But still, I think you would agree, Bill, not everybody is benefiting in this economy. Not everybody's doing great. You know, we just had the return of student loans here on October 1st, and a lot of the research I've been ingesting suggests consumers are pulling back, they're trading down to private label. How concerned are you that happens in your business and you see that trade down effect?
One of the things that we're seeing is that the consumer is going to the store more often, but spending a little less while they're there. The good news for a company like ours is we have such strong brand support and brand recognition that we are still getting the consumer purchasing power. They're just doing a little differently, and they're more careful about what they spend on any particular occasion. But it really hasn't significantly impacted. As you saw, our growth profile in this quarter in the beer business was up almost 8% on depletes. That's a very strong takeaway, and the takeaway in Circana data was even stronger, up double digits. So you can easily see that our business continues to perform extraordinarily well, and that really speaks to the strength and the brand loyalty that we have within our brands.
Bill, lastly, I was going to bed last night, I guess somewhere around midnight. I'm like, let me just check the Yahoo Finance homepage one more. I want to see what people are searching. I'm curious on what tickers they're watching. Some of the most trafficked and popular tickers on our page are Coca-Cola and PepsiCo. And there's a lot of concern in this country that the beverage makers, snacks makers, they feel an impact from these weight loss drugs that are proliferating throughout this country, that there is reduced consumption. Do you fear these weight loss drugs impacting demand for Modelo, Corona, or other products you sell?
Interestingly, Brian, we've never had it. We do a lot of consumer research. We've never had a consumer bring that topic up with us. And some of it is the whole social aspect of alcohol consumption. A lot of it is engaging with other people. There's a social element to it. And while there is a subsegment of that population that's interested in betterment, as we talked earlier, that's part of the reason why Corona non-alcoholic's done so well. The majority of people are not as concerned when they bring an alcoholic beverage into their mix of what they're consuming as they would in some other areas. We think certainly for our sector, it's overblown.
Fair enough. We'll leave it there. Constellation Brands CEO Bill Newlands, always great to get some time with you. As always, enjoy happy hour. We'll talk to you soon.
Thanks. Appreciate it, Brian.
All right, much more ahead on Yahoo Finance Live, including a chat with Levi's CFO Harmeet Singh on that company's latest earnings. We'll be right back.
Welcome back to Yahoo Finance Live, everyone. Third quarter earnings from Levi Strauss shined a light on a cost-conscious consumer after the denim retailer slashed its full-year sales outlook after struggling to attract customers at department stores and big box retailers. For more, we're joined by Harmeet Singh, Levi Strauss & Co. CFO and Chief Growth Officer, and Yahoo Finance's Executive Editor, Brian Sazi. Harmeet, always a pleasure to grab some time with you, especially after earnings here. I wish we could start off by talking about this Kenzo and Levi's collection here, but we got to talk about this quarter and particularly the outlook here too. And you and Chip had said you're focused on long-term levers within your control, actions you're taking during the third quarter to really begin to drive some improvements. Where are you seeing some of those improvements start to come through, and what other levers do you think you need to pull?
Good morning, Brian and Brad. Good to be here. Thanks for having me. Overall, the quarter was mixed given the macro uncertainty, but there are lots of things that are really working for us. First is our direct-to-consumer business, which is our stores, our e-commerce. Our direct-to-consumer business was up double-digit on top of high single-digit growth last year. Our international business grew and outgrew the company. E-commerce grew 18% on top of 16%. We exited the quarter, July, August, positive. So as we think about the levers, what we're really focused on is controlling the controllables. In the U.S., we also grew market share, men's, women's, and among the 18 to 30-year-olds. And so overall, there are lots of factors working for us. Unfortunately, our wholesale business in the U.S. and Europe was down, and offset the growth in DTC. From that perspective, our view is consumers are resilient. There is pressure in the U.S. For consumers who are earning between $50,000 and $100,000. That's showing up in wholesale. From that perspective, I took a call 35 years ago when I started my corporate life, never to talk about weather, good or bad, but it's been an unusually warm summer. I was in the UK a couple of times, and it was really warm, and that does have an impact, on apparel purchase, especially in wholesale, where most of what we sell is men's and women's bottoms. But our DTC business, which is a representation of more of a head-to-toe look, think of the light denim shirt that I'm wearing, is where the growth is. And so as you think about holiday season, we're really focused on a pipeline of innovation. We're bringing that to bear. Consumers still shop and love, brands they can trust. They're being a little bit more discretionary on what they buy and where they buy, but they love brands that offer consumer experience. They love brands that bring newness and relevance, and brands that offer price value, a good price value equation. And that's what we're as we look into holiday, we're cautiously optimistic, but we did bring guidance down because we missed revenue in quarter three. We beat expectations on profitability, but we took revenue expectations down and indicated that our EPS would be to the low end of our range that we'd guided a quarter ago.
Harmeet, Brian here. Good to see you. I think you're really focusing on a very key topic here in the economy. Today, we have a very strong jobs report, really stunned everybody on the street. More than 300,000 jobs created in this country. People think the economy is doing great, but you're really sending a different message. Those families earning $50,000 or less are struggling. Well, then how do you solve that from a Levi's perspective? Do you have to start promoting products to get these customers a new pair of jeans that they may clearly need?
Yeah, so it is, a tale of two. Is a tale of two worlds. You have the, low income to moderate income consumer under pressure. They have to take decisions, and they're being a lot more discretionary. Our view is when they shop, they want to shop with brands they can trust. They want to shop with brands that are offering relevant products. And so we bring that, and brands that give good price value equation. What we have done in quarter three, and it started being implemented by our customers in the US, we took 6 of our 120 fits, and we did reduce the prices make our products and our price value equation a lot more attractive. And then with innovation and the pipeline of newer products, I think that brings a lot more relevance. And so, we're offering, to the consumer really what he or she wants. And that, I think, for brands like us that continue to grow market share, will bode well for the longer term.
Harmeet, Chana here. Good to see you again. Going off of that, some of the challenges that you are seeing, the fact that you need to rely a little bit more heavily on promotional activity. How big of a headwind specifically has been the repayment, the restarting that we're starting to see of student loan repayments? How big of an impact do you see that being on Levi's, at least in the short term?
It's difficult to predict, Shauna, from our perspective, so we're really focused on what we can control. The good news for the industry and for us is inventory levels, and we mentioned this in quarter three, inventory levels, for the company at the end of quarter three was up only a %, better than what we thought. Trade inventory, which is inventory in our customers, is at a better spot. In fact, very close to 19 levels, and that should, we're hopeful that should help, reduce the levels of promotions. A year ago in quarter four, because of high inventory levels and the consumer being under pressure, promotional levels were higher. We're expecting promotional levels to moderate with better inventories, and brands like ours really offer good price value, and new relevant products make the difference.
Harmeet, I'm seeing more people out there wearing jeans that are not necessarily flattering on me, but I love it for them. Why not? And it's the baggy or the return of the wide leg pant. I know it's a perfect fit for Brian Saza. He does a lot of squats over the weekend. I do perhaps half of that. So all this considered, when we think about that trend, that shift back to the wide leg jean, how is that now priced in, factored into the Levi's story, and where you're even reallocating inventory for the coming quarters?
Yeah, we led that trend, Brad, and it was just before, the pandemic, broke. We started the looser fit trend, and we're leading the lower rise trend. Yes, you're right, and I applaud you for following fashion. Our women's business, even in U.S. wholesale, was up. So we're leading the trend on lower rise, baggier, looser fits. Our boot cuts are tracking really well. And, and now we're really focused on owning the head to toe denim. So we're, we're expanding into skirts, into dresses, and really product that she really wants, from that perspective. So being on top of trends, being agile, is what a DTC-led company does. And so that's why we're, taking a hard look at our go-to-market calendar, which was built for a wholesale business, and trying to see ways we can make it a lot more efficient and a lot more faster.
Harmeet, to be clear, I'm not banging out 25 squats in Levi's jeans. I know you would like me to. I just wanted to clear up any confusion for our viewers all over the world. But while I have you, in your earnings release, you did put a line that you're reviewing your operating model. So if I am an investor in Levi's here, and I'm not, but if I was, is there $50 million or more in expense savings in this model that you think you can remove?
We said we're reviewing our operating structure, and the basic, idea is we believe we can be faster, more agile, more efficient. I talked about reducing our go-to-market calendar. I believe we can drive more productivity in our assortment. We have a long tail. To your specific question on dollars, I'm not going to give you a dollar number, only because we have said that we will talk about the impact, which we think is material, and it will impact positively our results in 24 and beyond. We said we'll give it, when we report Q4 earnings at the end of January, early February. But overall, the outcome we believe is stores that are more productive and profitable, a supply chain that's more agile and efficient, cost structure, that is in line with revenue expectations, and inventory turning a lot faster. We have a goal as a company to get to operating margins of 50%. This only solidifies that goal and gets us there. And so I think just stay tuned, be patient, The two times that we have done it before in the last decade, the savings have been material. And so history is on our side.
One region that really seemed to outperform, Harmeet, that was China. And I think that surprised a lot of the folks that I connected with because of the slowdown in the Chinese economy. What are you seeing that consumer, and why does it appear they want Levi's jeans?
Yeah, broadly, Brian, our Asia region, was really strong. Asia grew in the mid-teens on top of strong growth a year ago. I was in Asia and in China a couple of months ago. The consumer is resilient. It's a younger consumer. Our brands are operating really well, and direct to consumer is a higher piece of the business. In Asia, we also have Performance Cool. I talked about the weather. Performance Cool is lighter denim, is a lighter bottoms, trucker and shirts, and that's really performing well. With global warming, there's no reason why we shouldn't be selling that in the Western world. Specifically to China, smaller piece of our business. We have a wonderful team on the ground. The consumer generally is sound, and China is where we sell our premium product. Think tier 1, tier 2. Think product that's over $200 and really doing well. And so, while we're not back to 19 levels of performance, they're having a double-digit growth now, I think stands well for our brand and our product. And really a shout out to the team on the ground because they're focused on really growing that business, over time.
Harmeet, you've had a brand that's been very open or scrutinous to some acquisitions, and rightfully so, to try and enter into kind of new consumer categories as well, whether that's the yoga category, thinking about Beyond Yoga, or Dockers even in that category, and pants, and of course the core Levi's business. Is there another category? I mean, I'm just looking at the front page of Levi's right now in this Kenzo partnership as well, and that kind of triggers this thought of, where is that next opportunity, and does Levi believe that it needs to buy into that or just create more timely partnerships and collaborations? Because collaborations have really seemed like they've taken hold of the fashion industry right now.
Yeah, collaborations are working for us and for the partner that we collaborate with. It's a win-win for both sides. You talked about Kenzo, there's the Crocs, etc. And so we have a very good lineup of collaborations. But to your broader point, we believe, we can be the best apparel company in the world, and that's offering more than just denim. Non-denim business, grew actually in the quarter, and we're just getting started there. As you know, we bought Beyond Yoga a couple of years ago to get into the athleisure business. That's working really well. Dockers and other brands, which are about $500 million of revenue today, had a decent quarter, grew, and Beyond Yoga was up 25%. To your question about different categories, as we think about M&A, let me start by saying the organic opportunity in this, in our current brands is huge. Having said that, if you want to be the best apparel company, the categories we really, take a hard look. Besides accelerating our tops and women's, there's the athleisure piece and then the outerwear. I think, our view is when you open your closet in the morning, you should see, a lot of product from the Levi's brands. And as the world becomes a lot more casual, and we are leaders in denim, there's no reason why we shouldn't be the best apparel company in the world.
Harmeet, always great to get your perspective and speak with you after these quarterly results. Harmeet Singh, Levi Strauss, CFO and Chief Growth Officer. Also, our thanks, of course, to Brian Sazi as well. You never know. Maybe we'll get Brad in those wide leg jeans before next quarter.
Maybe. It's hot out there. I need a lot of breathing room.
All right, we'll see. Harmeet, thanks so much.
That. So thanks, guys. Have a good weekend. Cheers.
I'll be sure to take a picture, Harmeet. Don't you worry.
Don't send it to me.
I need to see that. All right. Thank you.
Guys, have a good weekend. We got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq in New York City. Tech stocks have certainly taken a beating this quarter. The Magnificent Seven, the biggest players in tech, Apple, Alphabet, Amazon, Microsoft, Meta, Nvidia, and Tesla, all well off their 2023 peaks. But should investors reassess their tech investments? We want to bring in Mark Mahaney, Evercore ISI Senior Managing Director, also head of Internet Research, to discuss all of this and more. Mark, it's great to see you. Let's start with, you cover a lot of names, but I want to start with Netflix. The reports that we got out earlier this week about Netflix potentially raising prices yet again. The stock's still in the green since the start of the year, up just about 27%. What do you think of the report and how material this would be to the business?
I think it's a high probability that Netflix is going to raise prices again. They have a history of doing this. The wonderful term that they use, I think it's a euphemism, is called widening. So what they mean by that is they're going to kind of accordion or widen up their price points. So the high-end price points for you and me and all other consumers, $15.49 for the standard package, and then $19.49 for the premium package, something like that. Anyway, I think they're going to take those up over time, and this is how the company has kind of driven growth historically. Investor concerns over the last quarter centered on why ARPU wasn't growing faster. So this is the solution to that. It'll be a positive catalyst when it's announced. The big backdrop here is that the Hollywood writer strike, however, pushed off the time when they could raise prices because that meant that there was a contentful risk for Netflix. Once you get well beyond the writer strike, content starts coming back on, you get some good shows, you will see that price increase. I like Netflix as a stock. It's not one of our top picks, though.
And just quickly within there, where does AVOD fit into your valuation of Netflix as well? This advertising layered on tier as well.
Well, I think they expanded their TAM, their total addressable market. And so, Netflix kind of hit a wall at the beginning of 2022. They went 2 quarters without any sub growth. And then they announced they were going to get into the AVOD business. I call it SAVOD, subscription and advertising video on demand. I don't think they'll go pure AVOD, like only have an advertising revenue driven business. But the SAVOD business, I think it's going to work really well for them. We've only had early days with it. Maybe 10 million or maybe it's 5 million of their total subscribers are on this SAVOD plan. Now that's out of 250 million, so it's chump change. It's small, but over time, it'll help them gain more subscribers. And the beauty of this is, with the advertising revenue, they could actually drop their subscription price by a couple of bucks, by $3, and actually generate more revenue per user. Like, you rarely see that in business history. That's the big win here. We haven't really seen it play out in fundamentals yet, but I think it's kind of snowballed up there. See that impact next year.
Mark, let's talk about, you mentioned that Netflix was not one of your top picks, I believe. So what are the top picks? And I guess what companies do you see best positioned from here on out?
So we like Uber, Amazon, and Meta. Now, we're doing this against the backdrop of, we got a really strong employment report. That means that we're going to be, higher for longer. And that's going to create headwinds for tech stocks, anybody with long duration valuation, i.e. most of the value is in the future. But it's not the gale force wind that we had in 2022 when we went from 0 to 100 in terms of interest rates. We're going from 100 to 110 this year. Just to put it in context, that's a headwind, but not nearly as tough. But it also tells you that the high quality tech names, those that are generating lots of cash flow, have tons of cash on the balance sheet, those companies, those stocks should outperform the rest of tech. And my guess is that they've got good product cycles. And I think Meta does, I think Uber does, and I think Amazon does. I think that means they can still outperform the market between here and the end of the year. I still think there's a rally with mega cap stocks. It'll come down to the fundamentals, what they print in the next month.
So, Mark, Amazon being one of your top picks, one of the headlines this week, the fact that Amazon and Microsoft both facing a UK competition probe over their dominance in cloud. How big of a risk, or is this a risk really at all, that's worth worrying about when it comes to the future of Amazon?
Well, regulatory risk is going to be there. It's there for any of these large cap tech companies. I'm sorry, actually, I had not seen that announcement. I've been focused so much on the FTC lawsuit against Amazon, and I think it's a hard case to make against Amazon that they're a monopolist, given that they account for 10% of retail sales, kind of what Walmart is. So if you think Walmart's a monopolist, okay, then Amazon is too. But I just don't think that's true, and I don't think you can find real evidence that Amazon's harmed consumers. I've been doing survey work on Amazon for a dozen years. Every year we ask consumers, where do you get the best prices, best selection, and best convenience? It's Amazon. So it's a really hard case to make. In terms of the cloud market, we think AWS accounts for 30, 35%, max 40% of the cloud market. That's a big share. But I'm not sure there's monopoly power there. And by the way, the biggest, what any investor who's investing in Amazon because of the AWS thesis over the last couple of years is going to tell you is their biggest concern is that they're losing market share to Azure and maybe to Google Cloud. So I don't think there's any investors out there that think that Amazon or AWS is a monopolistic position in the cloud.
Mark, just lastly, while we have you, you mentioned Meta as one of your other top picks here, and I'm going to conjoin kind of two topics together in the interest of time because we've got to hustle to our finish. But one, the ad-free subscription tier that they're planning for Instagram and Facebook, how much does that show up potentially in the revenue and kind of building out a core base of paying users? And then on the other front, is the glasses play that they're putting forward with Ray-Ban, is that going to move the needle here too?
I'll go backwards. I don't think so. I don't think Ray-Ban does. I'm a little bit of a skeptic on the metaverse, although I think it's a good idea for the Meta, the company, to be investing, say, $5 billion, maybe $10 billion, but not the levels that they're investing in. But I think you can still be long Meta, despite the investments in Ray-Bans and metaverse, which I think are a little bit of a distraction, especially Ray-Bans. A little bit of distraction because actually I think that the core advertising business is recovering quickly. They still have this wonderful business model that generates $30 billion in free cash flow a year, high margins. They've got some wonderful product cycles that they're going into now. And then I think they're an AI winner, an underappreciated AI winner. There's an AI infrastructure winner, NVIDIA, AI platform winner, Microsoft. But if you want to find where the best applications of AR are now and where they will be in the future, it's right under your nose. It's right there with Meta. They're using AI to improve the user experience and the advertiser experience. It's one of the reasons it's one of our topics. It's also trading at 16 times earnings. It's cheap.
And then, okay, all right, Mark, we got to leave things there on the day. Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research. Thank you so much for taking the time here. I got to ask about that guitar that's behind you next time we got you. Appreciate it. Well, switching gears here and staying in music in some ways, there's no bad blood between Taylor Swift and movie theaters. As AMC announced, the singer's Eras Tour concert film has surpassed $100 million at the box office, and it hasn't even hit the theaters yet. October 13th, Friday, October 13th. That is this time next week. That's when so many people are going to be making their way into the theaters to see the tour that maybe they couldn't get tickets on, and maybe for some of them, they saw the tour, maybe not once, not twice, maybe 3 times, who knows, but they're going to say, all right, let me get that high-def camera angle as well.
Yeah, certainly. It's been remarkable, and I don't think many analysts, when they were out there making these predictions, anticipated that this was going to be a very hot commodity. People would be willing to pay whatever the prices were in order to go see this in theaters. A very smart move by AMC. The fact that they're also doing this with Beyonce's very successful tour as well. Certainly, I think a smart move by AMC. Does it really change the fundamentals of the company in the long term? No. But we are seeing, and we're sitting here talking about the fact that AMC capitalizing on this, the fact that everyone is talking about Taylor right now. And it's not just the diehard Swifties. We certainly have seen Taylor take over the NFL over the last 2 weeks, making the appearances at Travis Kelce's games. The fact that it was the most watched Sunday show since the Super Bowl, 27 million TV viewers, according to NBC Sports last Sunday when the Chiefs played at MetLife Stadium, really just shows the power of Taylor, how large her audience is, the fact that the Swifties are going to follow her, maybe capture or entice some new followers along the way. The fact that many people maybe who weren't talking about Taylor, those NFL fans, are now talking about her on a weekly basis. It's only going to help sales going forward.
You're spot on. I'm not even the biggest Swiftie out there. I would never even classify myself as a Swiftie, but I do classify myself as a person who loves to see some good camera work, especially when it comes to the people that put on these productions in the live show element and who are really taking in all of not just the experience and the performance that's taking place on stage, but the audience reaction, the absolute emotion that's pouring out on stage and from the fans. That's great to see, and it's great to see a lot of people being able to make their way to movie theaters if they couldn't get their hands on some of these very expensive tickets to go to see some of the concerts here that ultimately drove the experience economy over the summer as well.
It certainly did, and we even heard the Philly Fed, I believe, was they mentioned it in one of their reports talking about the fact that the demand for Taylor tickets and the fact that so many Swifties descended on the city, it actually helped their economy there. I believe that was in May. All right, guys, well, Taylor Swift is not going anywhere, and she's not going out of style anytime soon. Stay tuned for our special on the tailor-made economy next Thursday, October 12th. That all starts at 10 a.m. Eastern Time. Now, we want to recap the other big story of the day, and that, of course, is the jobs number. And taking a look at where things stand right now, markets remain under pressure here, at least for the Dow and the S&P. Recapping the big numbers that we got, that headline number blowing past expectations, 336,000, nearly double what the street was looking for. Unemployment holding steady at 3.8%. Average hourly earnings ticking up 0.2% on a month-over-month basis, year-over-year basis, growth of 4.2%. That was a bit better than what the street was looking for, so maybe a silver lining in this report. But we certainly saw the reaction when the market opened, and we're now well off the lows of the day. Actually, the Nasdaq just above the flat line there, but the Dow still off just about 78 points, and the S&P off about 0.2%.
Yeah, I think the added shocker within this report, too, the change in total payroll employment for July revised up by 79,000. You also saw the change for August revised up by 40,000. So with those revisions, employment in July and in August combined, 119,000 higher than previously reported. That's certainly part of the reaction that we had seen. Of course, yields, those moved higher. But ultimately, the markets, at least for the equity markets that had moved lower in reaction to the report, we're seeing the Nasdaq have some moderation here on the day. But as you mentioned, the Dow and the S&P 500 still squarely in negative territory.
Yeah, and it's also interesting taking a look into the sectors and where we did see that hiring. Leisure and hospitality leading with 96,000 new jobs. Really go hand in hand with what we're talking about when it comes to the consumer being more willing to go out to eat, spending on experiences. That being reflected in this jobs report. Other gainers, including government, adding 73,000 jobs, healthcare 41,000, and then you have professional, scientific, and technical services adding 29,000. That does it for us today on Yahoo Finance. But keep it right here. You have Rochelle Akufo and Akiko Fujita taking you through the next hour. We'll see you next week.
Happy birthday, Mom.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita along with Rochelle Akufo. Here's what we're watching at this hour. Shock and awe. The U.S. added 336,000 jobs in the month of September, nearly double what the street was expecting. What does this signal about the economy, and where does it leave the Fed?
And downside risk. Oil is on track for its largest weekly decline since March. So is peak fuel demand now behind us? We'll discuss.
Plus, just misunderstood. The Fed's higher for longer message has weighed heavily on REITs recently, but history tells a different story. Is now the time to buy the dip?
We shall see. But first, let's take a look at how the markets are faring an hour and a half into the trading day. Looking at a mixed picture, though still relatively flat. We see the Dow there still in negative territory, down about 44 points, though off its session lows. The S&P 500 also up ever so slightly as well. Tech leading the sectors, consumer staples and utilities, the laggards on the day so far. Tech-heavy Nasdaq there, though, the only one in the green there, up about 20 points on the day so far. Let's also check in on the Treasury market because we have seen bond yields soaring off of that strong jobs data. As we can see here, the 5-year up about 1.8%, the 10-year solidly they're at 4.8 right now, just up about almost 2% on the day. And the 30-year, the longer term yield, they're also up about 1.8% on the day. Well, stocks are sinking today in response to this morning's job report. The tech-heavy Nasdaq, of course, taking the biggest hit. So, Akiko, as we look at these, we look at especially the bond yields as well. We're looking at the 30-year at 20-year highs, and of course, those higher bond yields make it more expensive for consumers and companies to borrow money. That means that starts to undercut the economy, and then that brings up more stoking of these recession fears, which the 10-year has essentially been flagging pretty much all year at this point now. So really raising the likelihood of a recession, which is why we saw that sell-off on the news. But now we're seeing the stocks actually picking up some ground here.
Yeah, we have seen it off of the session lows, but certainly a big reaction to that big number that we got this morning, 336,000 jobs added in the month of September. To your point, we've been watching bond yields very closely because we have seen credit tightening. In some ways, you could argue the bond market doing the job for the Fed, the 10-year yield getting closer to that 5% level, hovering at that 16-year high. We saw the 30-year yield sort of pass that 5% level, although it has pulled back since. And then, of course, if you look at the dollar index there, we've seen the spike in the greenback. So certainly overall, some big moves on the back of that. When you think about what this now means for the Fed, the market's certainly reading it as a possibility that the Fed may step in to hike one more time this year. But Rochelle, let's walk through the numbers here because, while the headline was certainly a big number, well past expectations, what the street was expecting. But if you look through some of these numbers, there is some moderation that's happening. Payroll or wages, hourly wages, certainly one thing that you could point to there. It was up 4.2% year on year, but it did pull back slightly in terms of the pace of those increases. And then, of course, if you look at sectors here, leisure and hospitality, really the big one with the gains there, 96,000 jobs added there.
It's true, and you have to also then factor in seasonality as well. As you mentioned, the 96,000 in leisure and hospitality. Government employment, though, also rising by 73,000. And healthcare was the next one that also saw more gains as well, as we look there at construction, manufacturing, and healthcare there. So, but it really does make people sort of scratch their heads. We thought we had a handle on where the job market was heading, but now with this surprise here, and as you mentioned, perhaps this credit tightening continuing to do the Fed's job for it, but still, that next rate hike coming in as a stronger, much stronger possibility than analysts thought.
Yeah, also an upwards revision in terms of the jobs numbers from the previous month. So, you could argue that the Fed going into that meeting was looking at a stronger jobs market than expected. But let's talk about where those things stand or where things stand for the Fed. As we said, the 336,000 number well above expectations. That was at 170,000. The Fed's been watching the labor market closely as they try to assess the need for further policy tightening. Joining us now on what this new print means for the Fed and the economy is Robert Sotkin, global economist for Citi. So, Robert, I'm going to have you break it down a bit here because as we've been watching the market, it's a strong reaction. Initially, we have seen this come off of session lows in terms of the majors. We've seen yields, sort of spike and sort of pull back just a bit. To what extent does this print we got today strengthen the case for another rate hike this year?
Thanks so much for having me. And that's a great question. I think going into this week, the Fed was looking at a labor market that seemed to be moderating materially. The quits rate had normalized back to pre-COVID levels. Job openings were coming down. Job growth was moderating. And a lot of those factors got thrown in the other direction. You saw job openings surge in the latest print. And of course, this blockbuster jobs number that you saw in the payrolls report today. So I think on balance, it puts the Fed in a difficult spot because on the one hand, they're seeing very strong labor demand and very strong hiring, probably at an unsustainable pace. On the other hand, you also saw wage growth come in a bit softer than expected. I think for Fed officials, they'll look at these numbers and mostly focus on the job figures and say, well, at these levels, wage growth has upside risk and is probably going to move up from here. So I think it strengthens the case for another hike, but it doesn't guarantee it given that you're getting some mixed signals on the wage side. And you've had this big rise in long-term yields that is doing some of the work for the Fed. So I think the next meeting in November is going to be a close one, but on balance, this strengthens the case for another hike.
But you have to wonder then, how did analysts get this so wrong? Is it about seasonality or is there something else at play here? Because, this was a huge difference between the expectations here and what we got for September's numbers.
Yeah, it's a great question. And I think some of it's going to be seasonality. You always have in some of these reports, you always have very difficult issues in adjusting for certain seasonal factors, such as when the school year starts and various education-related hiring. But on balance, I think what people have been looking for is the Fed has hiked rates a lot so far in this cycle. People are expecting that to play through with a lag. And you've seen some of the indicators of activity soften, but the labor market still refuses to slow down. I think a great example is within the goods sector. We know goods demand's been very weak globally. Surveys of manufacturing have been soft, and yet the manufacturing sector keeps adding jobs. And so I think you're seeing a lot of mixed signals within the indicators, and that expectation that things are going to slow down because the Fed's done a lot of work hasn't just really been playing out as people expected.
Robert, on the one hand, going back to the wage discussion here, we're seeing some moderation, not as significantly as potentially the Fed would like. And yet we have seen this summer now going into fall of labor strikes. We've got obviously the UAW strike that's been happening. Hospital workers, healthcare workers from Kaiser Permanente now on strike as well. All of those strikes are demanding higher wages. So how do you sort of square these two? And going back to your earlier point about that risk to the upside, does that kind of strengthen that point?
Yeah, absolutely. And I think these are the things that Fed officials are focused on. We're seeing in terms of private sector strike activity, the largest numbers we've seen in 2 decades. And the thing is, when you look at each individual strike, given the size of the labor market, they're not that big on their own. So for example, 150,000-ish auto workers, the labor market's about 130 million employees. So in terms of scale, each individual strike is not that large. But what I think it's signaling is that we're potentially in a moment where labor is demanding more compensation, and that could spill over not just into the industries that are striking, but other people within other industries that are watching these strikes and saying, well, I want to push for more higher wages in my contracts as well. So I think the strike reflect this potential push for higher wages that could potentially be persistent. And it's exactly the type of shift up in inflation expectations and wage expectations that the Fed would be worried about.
So, Robert, then when you couple that with the jobs data and the correlation with consumer demand as well, how is that then informing your economic outlook and your base case for a recession?
It's a great question. And we're really stuck here between what we're seeing in the data and what history tells us. So we wrote a paper looking at every period since 1965 where wage growth had to fall more than 1.5 percentage points over a few year period. In this cycle, wage growth peaked at around 5.5%. The Fed's comfort zone for wage growth is somewhere, we think, in the 3 to 3.5% range. So that means that the Fed needs wages to fall about another point to a point and a half from where they are now. And in all episodes that we found since 1965 where this happened, there were 5 of them. All 5 coincided with a recession, and all 5 coincided with a significant loosening in the labor market. So history tells us that given these dynamics, a recession is likely. But so far we've seen wage growth come down, inflation moderate, and the labor market remain very resilient. So it's possible this time is different. History would tell you a recession's needed to get that extra leg down in wage growth. But so far the data have been impressive. So for myself, think a probability of a soft landing at this point is somewhere around 50-50.
Robert, finally, we have seen a rapid rise in bond yields. You're going from the shorter end to the longer end, hitting 15, 16-year highs. It feels like the Fed's messaging, though, has been consistent about keeping rates higher for longer. I'm wondering what you think has changed. I realize you're not a market strategist, but just looking at where things have moved, what do you think has been the trigger?
Yeah, it's a great question. I think what you're seeing in the market is most likely a combination of 2 things. One, people are expecting this higher for longer narrative to last well into the future. And it's possible, some measures that you look at them, markets are expecting, the Fed to maintain a policy rate north of 4% for the foreseeable future. That seems a bit high to me, but I think that's what the market is grappling with, is that given these inflationary pressures, given the resilience in activity, even after the Fed has already hiked rates so much, might mean that rates need to either move higher and potentially stay restrictive for a long period. The other element is on the term premium. And I think in there, it's a mix of factors, worries about uncertainty and inflation and interest rate variability. And then, of course, the fiscal situation. The fiscal numbers are looking pretty extreme. And there's a lot of issuance from the government that markets are going to have to pick up. And I think that Fitch downgrade and the Treasury reissuance that really brought front and center to markets just how big these deficit numbers are going to be, I think that's been a major factor driving up these term premiums. So I think when you put those together, it's the higher for longer and it's a rising term premium, and you're getting a pretty big pickup in the long end as a result.
We're certainly seeing that continuing to play out as well this morning. Appreciate you joining us this morning. Robert Sorkin, Citi Global Economist. Thanks so much.
Thank you.
Well, September jobs report blew past expectations, but even with huge gains, the ongoing strikes took a bite out of numbers. Here with the latest is our very own Alexandra Canal. Hey, Ali.
Hi, Rochelle, that's right. The Hollywood strikes registered yet another hit to the jobs report last month as the writer's strike reached its conclusion while the actors remain firmly on the picket lines. According to that data released by the BLS this morning, employment in motion picture and sound recording industries decreased by another 7,000 after falling by 17,000 in August, reflecting the impact of labor disputes. And since the strikes first began in May, employment in those industries has declined by 45,000. Now, even though we have seen the writer's strike end, the actor strike is still ongoing. The union, SAG-AFTRA, they will continue to meet with studios today after restarting negotiations earlier this week. The hope is that a conclusion can be reached soon so Hollywood can get fully back to work, because we have seen a significant impact on the U.S. economy, not just with these job numbers. Milken has estimated that the dual work stoppage will cost the U.S. economy $5 billion plus, primarily due to those lost wages. And we know that just beyond Hollywood, there are strikes in other industries, like the auto workers, for example. We did not see the UAW strikes be mentioned in this report, but that doesn't mean that we won't see that strike activity reflected in future jobs reports. Remember that the writers' strike started in May. We didn't see that hit until August. So likely more pain to come as these strikes present yet another challenge to this labor market, despite that blowout jobs figure that we did see earlier today.
Now, Ali, October was always seen kind of as a deadline, especially for SAG-AFTRA as well as WGA. to get a deal done so you can salvage the year, so to speak? I mean, we're at October 6th right now. What's the expectation here in terms of how quickly some of the production can bounce back if SAG-AFTRA reaches an agreement?
I think we're still going to have to wait until 2024 to really see a lot of our favorite shows come back, to really see the box office return. We've already seen that impact happen so far. If you just take a look at some of the top movies that were supposed to come out in the fall, that Dune sequel from Warner Brothers, that was highly anticipated, that was pushed into 2024. So even though it's definitely a good sign that we're seeing writers come back to work, we still need the actors as well to get some of those scripted series up. That being said, we have seen those talk shows, the late night television return, or they are going to return over the next few weeks. So I think once we see the actors get back on board, it will be pretty quickly that we'll see some return and activity there. But it's still going to take some time to get people back to their jobs. But hopefully by early to mid 2024, we start to get a little bit back to normal, because I know I'm missing some of my favorite shows, and I don't want to have to wait 2 or 3 years to see the next season of The Summer I Turned Pretty. I mean, season 3, we got to get it going now. So I'm hopeful that we will see a return to work very soon for Hollywood.
We all got our priorities, Allie, but you're certainly not the only one. People looking for new content out there. We'll see how quickly things can bounce back. Allie Canal, as always, thanks so much for that. Well, shares of Taiwan Semiconductor moving higher this morning as its third quarter revenue fell less than expected, down 11% year over year. The chipmaker saw demand from AI developers offset sinking smartphone and laptop chip sales. Certainly a promising sign, Rochelle. TSMC, not the only chipmaker out there that has been really concerned about declines we've seen in laptop sales as well as smartphones. You look at numbers from IDC, they're expecting about 14% decline in laptop sales alone this year. So AI chips, certainly helping with that cause. And TSMC, of course, manufacturer to many other chip designers as well. So they are certainly the beneficiary on the back of that demand.
And I think it really clarifies that when we talk about chip makers here, the types of chips that we're talking about, because we're talking about what was offset by the strength in these AI chips. But even then, there are supply constraints. So clearly there's the need for the AI chips. But if you are not able to supply them because of constraints, that's obviously going to weigh on the stock here. But then when you look at what we've been seeing with laptops, this is something that we've seen a steady decline in when it comes to laptops and PCs. And I think investors are really going to be looking into what's next in those markets, or are they just going to stagnate? People bought a lot of their gadgets, their laptops, their PCs during the pandemic. So we're continuing to see that leveling off. But obviously, AI, the future here, but wanting to see a bit more momentum and waiting for some of those supply chain constraints to work their way out. All right, well, all your markets action ahead. Do stay tuned. You're watching Yahoo Finance. oil futures volatile today, with prices now headed for their biggest weekly drop since March. Concerns about global demand continuing to outweigh any concerns about supply. That's even as OPEC Plus maintains its production cuts. Let's bring in Yahoo Finance's Inez Ferret to give us those details. Hey, Inez.
Yeah, Rochelle, and if we take a look at WTI, it's stabilizing right now, but keep in mind that over a week ago, these prices were at their highest level this year. Right now, we are looking at a 6-day chart, and WTI is down more than 9% this week. A lot of the heavy selling went on Wednesday and Thursday, a flurry of options trading that exacerbated the selling. Also, concerns about demand that also was not helpful for the selling. Now, the selling may be overdone, though, according to some analysts, like Barclays analysts, saying that the recent correction in oil prices has been too rapid. They also say that this narrative of demand destruction doesn't really stand because of the fact that very little of the recent run-up that we've seen with oil prices has been passed on to the consumers. Now, yesterday or the day before, we had earlier this week the EIA data that came out about gasoline demand being at its lowest level in 25 years, and gasoline futures have been lower. This is a 12-day chart that you're looking at of gasoline futures, a 1-month chart here. Also, want to take a look at where we're at with some of the energy stocks, because we are seeing ExxonMobil, which is under pressure. This is after a Wall Street Journal report talked about ExxonMobil being in talks to acquire Pioneer Natural Resources. This would be Exxon's biggest acquisition in more than 20 years since it merged with Mobil. And it would make ExxonMobil a dominant U.S. producer of shale oil. Now, the deal is valued at as much as $60 billion. Analysts have been mostly positive about this. You've got Citi analysts that are saying that the consolidation in this really fragmented Permian shale remains compelling. They're talking about economies of scale. And ExxonMobil has been really on the lookout for an acquisition. But of course, oil prices have been very, very volatile since the pandemic began. You'll remember when oil prices went negative and the energy companies were underwater, then they spiked. This year, they have also been volatile as well. But it's a good time for ExxonMobil if you look at their stock price, because they just recently hit new highs. This stock price was at $120.70. So they're not too far off their highs, guys.
Yeah, it has been a wild ride. And as when you consider where these oil majors have been over the last few years, certainly interesting deal, though, potentially in the works. And as for as always, thanks so much for that.
Thank you.
Well, the recent debuts of Instacart and Klaviyo have led to renewed appetite for tech IPOs in the public market. But the latest data from Crunchbase points to continued declines in the private market, with global venture funding in the third quarter reaching $73 billion. That marks a 15% drop year on year. Let's bring in Crunchbase senior data editor Janae Tier to discuss more. Janae, always good to have you on the show. When you look at those declines in the quarter, where'd you see the biggest hits? Is it in the late stage rounds or is it in the early rounds?
So I think the interesting thing is the hit that we're seeing this time around is in the early rounds. And we're 5 to 6 quarters into the decline. And this is the second lowest quarter we've seen since we've been tracking the decline. And it's really interesting that it's early at late stage, because investors have largely stepped away from those very large rounds, the high valued companies. That's where we saw the biggest decline in the months when the decline started in Q2 and Q3. So this quarter, it's early stage funding, which is down by the biggest percentage.
And when you look at some of the biggest names that have been creating buzz in the IPO space, then is that overshadowing what's actually happening in the IPO space? Because you have a lot of these that were tied to some of these big AI pushes, but what's the actual sentiment and appetite for VC funding right now?
Yeah, I think the appetite is still incredibly cautious. Obviously, we've had Klaviyo and Instacart go out. There's a little bit of liquidity. The venture markets take time to react, so you're not going to see the reaction in the quarter afterwards. But I think based on how those stocks have performed, there's still a lot of question mark and still a lot of risk concerns for venture investors. And I think the way venture investors are seeing this, the fact that they're not investing heavily at early stage suggests that they're not seeing those interesting companies come through that they really want to back at the earlier stages. And I think that's because those investors have invested. They're seeing a lot of companies who are struggling to sell. companies have cut back, they're not buying product. And so if you're going to invest at seed or at early stage, a company has to be very differentiated and stand out in the market. And I think those companies are not coming through for venture investors. So still a massive pullback we're seeing this quarter.
Janae, that begs the question, what does the pipeline look like into the public markets? I'm looking at your data here. The late stage funding was up by more than 25%. Does that suggest that some of these bigger VC-backed companies will stay private for longer, given just how choppy the trade has been for the likes of an Instacart or a Klaviyo?
Yeah, I think what's interesting about the late stage increase that we saw this past quarter, and it was up year over year and also quarter over quarter, a lot of that was concentrated not in the US market, but within China. We saw large investments go into very strategic sectors. So AI, semiconductors, battery tech, electric vehicles. So these are industries which need huge investments for these companies to take off. In Europe, we also saw late stage funding up, again, sort of in the electric battery space. In the US, we saw very large fundings go into AI, but late stage funding was not up in the US. So I think this is more reflection of strategic investing and sectors that need very large rounds rather than excitement about the IPO markets. There were a few rounds. Databricks did raise a very large round at the highest valuation this past quarter. They were valued at $43 billion, up from 38 when they were last valued in 2021. That's a company that is clearly beginning to prepare to go out. So there are a few of those rounds, but it's way more selective.
So, Janae, when a company is trying to determine if the timing is right or if the company is well positioned enough to go public, either via traditional IPO or via SPAC, what should be on that checklist?
Yeah, I think for most of these companies, what they're looking to do, and we saw this in the 3 recent companies that went out, is that they need to be profitable, if not immediately profitable, show a path to profitability. So what I hear from all investors is loss-leading tech companies are not going to do well in the public markets. I think the other issue that we saw was there's a lot of price sensitivity because tech stocks from 2020, 2021, and 2022 are way down. And so what we are seeing as these companies come to the public markets is they do not want to overprice. They almost don't want to price even at the top of the range, although some of those companies did because there was a lot of investor interest. So I think a lot of price sensitivity when they come to the public markets.
What does that late stage look like right now, though, in terms of valuation? Are some of these companies able to command higher valuation, or are we seeing some down rounds and these companies willing to take that on because they need the funding?
I think mostly what I'm hearing from people is that we're seeing a lot of companies do top-up rounds, so not really full rounds, which are where the valuations are not released. And it's almost like no one's raising funding, but everyone is silently there to take some money if you want to give it. And so we're seeing just top-up rounds happen in the market in late stage and less of these, we're going out, we're raising a full round at a much higher valuation.
Certainly a more sobering landscape, to say the least. A big thank you there to Crunchbase Senior Data Editor Janae Tier. Thank you so much.
Thank you.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. This week, the Supreme Court heard oral arguments in a challenge by payday lenders against the constitutionality of the funding structure of the Consumer Financial Protection Bureau. For reaction on this, I want to bring in Rohit Chopra, Director of the Consumer Financial Protection Bureau, here in an exclusive interview. Director Chopra, thank you so much for joining me. It's great to see you.
Good to be with you, Jennifer.
Your reaction to the oral arguments this week, the justices seem to be a bit skeptical.
Well, look, I think the whole financial markets are much better off with the CFPB there. I think if a CFPB had existed in the early 2000s, we wouldn't have had a subprime mortgage crisis. I think we saw a really stellar argument from the Solicitor General of the United States, and the CFPB is going to continue to do its work on medical debt, on data privacy when it comes to our transactions, to junk fees, and so much more. So the business of the CFPB continues.
If the court were to invalidate your funding structure and cast doubt on a wider set of regulations beyond payday loans, what would that really mean for financial consumer protections and particularly mortgages?
Well, one of the things that the Solicitor General discussed was the mortgage industry. You know, many mortgage lenders tell us how much they depend on the clarity from the rules that have been put out, in many cases, over a decade ago. I think many in the mortgage industry are already facing so many challenges when it comes to the higher interest rate environment. We see refinancing activity and loan origination activity go down, and this would add even further uncertainty and really cause a lot of headaches for consumers too.
Switching gears, you made remarks this morning on the U.S. payment system. You say that big tech is taking advantage of the financial system, threatening the divide between banking as well as the economy. What are you looking at as far as new regulations, potential new rules for the U.S. payment system and big tech?
Well, one of the things that I think we're seeing in the market is that the U.S. is really lurching toward a market structure that's more like what we see in China, one that is fueled by a lot of surveillance and even censorship, one that actually mixes up banking payments with commercial activities. And we've had a long tradition in our country of trying to separate banks from the real economy so that they're supporting other businesses, not steering to those businesses. And obviously, big tech firms are, in many cases, trying to come up with their own currencies. We saw this with Facebook and its doomed Libra project several years ago, and more are coming up with those ideas. So we need to make sure the payment system is fast and safe for consumers, but really fair for everybody, not just big conglomerates.
So then what are you looking at as far as new rules in that space?
Well, one, we've talked about the need to make sure that those consumer payments firms are not really trafficking fraud. Fraud is a big issue when it comes to consumers and new forms of payments. We also talked about how all the regulators need to take a look at these private digital dollars that are sometimes referred to as stable coins. We need to make sure that they actually are stable. We're looking at ways to restrict how some of these payments firms can harvest, surveil, and monetize our personal data. Later this month, we're going to be proposing some rules when it comes to open banking and personal financial data rights so that Americans can have confidence when they share their financial data that those companies aren't reselling it or trafficking it for purposes that the consumer never even wanted.
You've already done a report on big tech. You found that Google and Apple are serving as choke points to the U.S. payment system, preventing smaller players from coming in and hurting innovation. And you mentioned this morning that you're set to issue a supplementary order on big tech to get more info. What are you looking for specifically there?
Well, I think we want to know really what are their business practices and plans for new currencies and what information are they using. one of the things we released last month was an analysis of the regulations that some of these big tech firms impose on users of their payment systems. We found that Apple, for example, blocks other apps from using near field communication or the tap to pay features. It's worrisome when we don't have a real open and decentralized system that consumers and businesses and new types of startups in the financial sector can all use to get ahead. So we're going to be continuing to look really carefully at how that data harvesting and surveillance is working.
You said the US payment system is careening towards a Chinese style system. I'm curious what that means for a CBDC in your view and the role of privacy concerning that. Do you think, would you be for or against one?
Well, there's many different ways you can have digital currencies, both issued publicly or privately. What I really focus on is what is it going to happen? What's going to happen to the consumer? What's going to happen to their data? And what we see in China in WeChat Pay, Alipay, these are really ubiquitous services in China. We think that there's an enormous amount of surveillance and even certain types of censorship that go on through these payment platforms. And I think in the US, we've really tried to create systems that are fair, open, and private at the same time when it comes to the use of our money. So there's a lot to think about there, but I do want to make sure that we are really looking at the risks posed by big tech firms trafficking more and more of our transactions.
I know you're worried about a run potentially on stablecoins and what that could mean for the economy. Specifically, wondering about how you view Tether, because Tether is such a black box. I'm wondering what concerns you most about that, and if you know who the corresponding bank is in the U.S. for Tether, and does it worry you that Tether has been buying up more U.S. treasuries than perhaps some countries like Spain?
Well, I don't want to comment specifically on one stable coin. All I'll say is, in general, we have seen many of those coins were primarily used for speculative trading in crypto markets. The question on the table is, to what extent are any of those coins going to be used in consumer payments? It's been widely publicized that PayPal is looking to create their own private currency or stable coin. We obviously have the experience with Libra, but there is really a lot of risks to consumers and to the financial system if a widely used digital coin is not actually stable at all. We have seen some of the consequences about this throughout our history. So one of the things that we have described is that there are some authorities on the books today, including through the Financial Stability Oversight Council, where that may be a way to get more safeguards and, frankly, Jennifer, more transparency as to what is backing some of those coins.
Are you looking at PayPal's crypto that they're looking to issue? Does that worry you at all, or are you circling that at all?
Well, I think all the regulators are taking a hard look at any new proposal for a large-scale alternative private dollar. It raises a huge number of questions about consumer fraud, about privacy, and even our national security. Look, I think everyone saw the warning signs from Facebook's Libra project in 2019. We want to take a hard look at any type of proposal that's out there. Obviously, PayPal, which operates also the Venmo product, has had a number of run-ins with the law when it comes to their compliance with consumer protection and privacy laws. So obviously, it's going to require a close look from all the regulators.
Before I let you go, Director, I know that you sit on the board of the FDIC, which, along with the Federal Reserve, has put out new proposed capital requirements for Basel III. The banks vehemently oppose these proposals. They say it could hurt credit availability in the United States and push banking into unregulated areas like the shadow banking system. Is the FDIC at all considering softening certain areas of these capital proposals?
So look, I think at the end of the day, we all need to remember what really happened when banks were on the brink of failure, especially around the time of the financial crisis. The answer ended up being lots and lots of bailouts. I don't think we can have a system where banks and bank executives can roll the dice where they get all the winnings, but then taxpayers and our economy are holding the bag when their bets go badly. We've got to make sure that if they are taking insured deposits, that they have some real skin in the game. So we propose some rules. We're going to take lots of public feedback on it. But of course, I have never met a single banker that ever wanted to hold more capital. So it's no surprise that they will not want to do this. But we've got to think of our country and the economy too.
And Director Chopra, thank you so much for your insight. It's so appreciated. I hope you'll come back and see us again soon.
Thanks so much, Jennifer.
That's Director Chopra, head of the Consumer Financial Protection Bureau. You're watching Yahoo Finance Live. We'll be right back.
The Fed's higher for longer message has weighed heavily on REITs recently, flirting with lows not seen since May of 2020. But historically, REITs have actually performed well when interest rates rise, often outpacing stocks. So is now the time to buy into the dip? Well, Wedbush Securities began initiating coverage earlier this month of the US REIT industry. Richard Anderson, Wedbush's Managing Director of Equity Research, joins us now. Thank you for joining us this morning. So just to set the stage here, why have we seen this disconnect when REITs traditionally do well in a rate rising environment?
Well, I would maybe counter that thought a little bit. I think the REITs tend to underperform in a period of rising interest rates, but then have a tendency to outperform once we reach an end of a tightening campaign, which we think we're at least closing in on that. Putting aside the jobs number from this morning, we think we're at least well past the peak pace of tightening from the Fed. And our call is really an aim towards 2024, where we have a little bit more in terms of interest rate visibility, economic visibility, and a new interest rate paradigm in the United States. And that's the point where once we have some stability, we start to look at the REITs and carve them out from the rest of the commercial real estate industry and start to look for opportunities to buy a space that has underperformed dramatically over the past few years.
And so, Richard, we can talk about strategy in just a bit, but I want to just get your take on what we've been seeing, at least in bond yields here. We have seen a rapid rise there, the 10-year now hitting hitting that 2007 level. Looking at your notes here, you see your thesis is 4 to 4.5% range. You know, we're inching above 4.8 now. I mean, what happens if we start to hover close to that 5% level? Although we could argue we're already, sort of getting there.
Yeah, I did offer in the note that it might trickle above that range in the short term. So I gave myself an out. But I don't think it's so much about the absolute level of the 10-year as much as it's the change in the 10-year. So yes, we're hovering above my 4 to 4.5% range, and we may get to 5. But what I'm looking for is stability. Whatever that number is, we get to a point where the year-over-year impact from higher interest rates becomes more of a wash in terms of earnings for the REITs. And then we have the conversation about where do the REITs stand, again, relative to the broader commercial real estate industry. They're the most underlevered, the most sophisticated of the space. They only own 10% of the commercial real estate industry. So I would argue that whatever that number is, assuming it doesn't go to 10 or 11%, that we have an opportunity for the market to assess who in this field is most vulnerable to a higher for longer situation. And I would argue that undercapitalized private owners of real estate in general are the places where there's more risks. And that's where the REITs can come in and deploy their balance sheets and actually turn this into a positive story for the space going into 2024 and into 2025.
And Richard, I know you disagree, but I mean, history does show that REITs actually do perform well in a rate rising environment. So I want to hone in on some of the ones that you're actually favoring at the moment within commercial real estate. You're looking at multifamily, industrial, senior housing, and niche office. So talk about the distinction, especially in office, because it does all tend to get lumped together.
It sure does. And I think that is also an opportunity. If you spend any time listening to how commercial real estate is discussed in any outlet, sometimes the word office and commercial real estate are used interchangeably, and that's an important distinction. There are some really good asset classes in the REIT space. You mentioned many of them. Multifamily is apartments for rent. What's happening there is mortgage rates, as we all know, are up at all-time highs, and that makes it very difficult for someone renting an apartment to go and buy a home. And likewise, you have student loans now having to be paid back, less wealth for renters to leave and go and do something else. And so that's a good source of stability for multifamily, again, going into next year. Industrial has been the beneficiary of e-commerce. I think that will continue. A lot of demand for warehouse space and fulfillment centers that will continue to grow. So we like that space. Senior housing is sort of a cousin to multifamily, taking care of the old people of the country. And that's a recovering story. Post-pandemic, we've seen, during the pandemic, we saw occupancies drop 100, 1,000, 1,500 basis points, and now that's in recovery mode. And then niche office, getting back to that, what I'm saying there is conventional office is going to have its difficulties as tenants try to figure out what they're going to do when their leases expire. The niche office is like life science, where there's an absolute need for the space for biopharma tenants, or medical office, where there's an absolute need for hospitals and doctors that see patients. That's where we like the office space, in that niche category of the office arena.
Okay, well, we'll be watching to see how those perform. Richard Anderson, Wedbush Managing Director, Equity Research. It's good to talk to you today. Appreciate the time.
Thank you for having me.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance. Well, we're talking about a software slump now, with software stocks feeling some pressure on hawkish Fed fears and macroeconomic pressure in the last month. But is now the time to buy? Yahoo Finance's Ali Garfinkel has the details for us. Ali.
Akiko, for software stocks right now, as Olivia Rodrigo would say, it's brutal out there. And while it sounds like I'm being facetious, September was actually the worst month for tech stocks since May, and going into this month, that slide has continued. We're still, and right now it's software, of course, in the crosshairs, right? Salesforce, Adobe, both down more than 8% over the last 4 weeks. And it really comes down to macro pressure. Yes, it's high interest rates. There's also really limited visibility at the end of the year as to where clients are going to be spending and how comfortable they're going to be doing that spending. That said, I think it's important to say we've seen this movie before. There's history here. Over the last 12 years, the software space has had a number of pullbacks, especially in the second half of the year, and then those stocks will leap off the bottom. To this end, Evercore analyst Kirk Matern had some advice for investors. It's a very Olivia Rodrigo-esque take. What he writes is, embrace the suck, but only if you can take a 6 to 9 month view.
Ali, this might be a first, I think. Software and Olivia Rodrigo. I did not make the connection, but let's talk about those investors who are looking into the space. What companies are analysts calling out as having upside?
Olivia Rodrigo's side, look at the large caps here, Akiko. Look at Adobe, look at Intuit. And yes, Microsoft is in that bag, but Microsoft is perhaps the most obvious of them. If you think about Adobe, think about AI. They're rolling out AI features left and right. Intuit, same deal. Investor Day, generative AI was really featured. That's what we're expecting to see help kind of lift these companies off the bottom. That's certainly the story, at the very least, that they're selling to Wall Street. And I should say also, Wall Street is optimistic about a few smaller caps. Snowflake, CrowdStrike, HubSpot are in that category. That said, if you're an investor saying yes right now to software, if you're really ready to invest, remember, you're going to be embracing the suck.
Well, that'll certainly be a line to leave us with as we go into the weekend. Appreciate you, as always, our very own Ali Garfinkel. All right, well, let's get to a final check of the markets as we head into the noon hour. As we can see here, all three major indices now in the green. We see the Dow here really picking up here, up about almost 300 points on the day, or about 1%, really recovering some ground after that hot September jobs report put more fears that there might be another Fed rate hike on the table coming in November. Looking at the S&P 500, still seeing tech leading the way here, up about 37 points on the day. And the tech-heavy Nasdaq there, up about 137 points, or just over 1% on the day. And of course, next week, we have a lot of things to look forward to, including big bank earnings coming in as well, which will be our kickoff to the earnings season. We'll have to see how some of these big banks really factor in some of the momentum that we've seen in the jobs market and how the Fed might play that out, Akiko.
Yeah, loan loss is certainly going to be in focus there as well in terms of where banks are likely to perform. But a real reversal we're seeing in the markets. We should leave you with where we're watching bond yields there, because we did see the 10-year jump as much as or more than 10 basis points early on the back of that hot jobs report. Now seeing a bit of a pullback there, although it is at 4.76% on the shorter end. We're looking at just at 5%, and the 30-year yield hovering right below that 5% level. Certainly going to be in focus moving forward. But that does it for Rochelle and I on this Friday. Have a great weekend. We'll see you right back here on Monday.